I welcome you all. Every company in the real world needs the best people, the best financial analysts, best business consultants, best investment bankers, and all the best people. And if you are among those people, then this course is for you. In this course, I shall guide you through the practical real world financial modeling. This course is divided into 12 modules, and on those modules, you shall learn about calculation of weighted average cost of capital for the real world companies, your projected financial statements, your projected cash flow statement, projected balance sheet, and projected income statement. This course is totally done through Excel, and in the Excel you shall be working along with me while I will be guiding you. And once we have done our workings, we will get our financial modeling report, and this report shall be submitted to your client if needed. If you are a student who want to get a job in investment banking, if you are a real world business or finance practitioner, if you are a professional who desires mastery over the financial modeling, or you are a business analyst or consultant, then definitely you can join this course. In this course, you shall get your on-demand video session, your articles and downloadable resources for lifetime. You will be practicing in the Excel along with me. There will be doubt solving through the messages. You will have a lot of assignments and quizzes. And finally, once you have completed the course, you will get the certificate of completion. And if you want to ask about myself, so I am a chartered accountant and I have more than 7 years experience in working with listed companies. I have taught more than 15,000 students online and offline around the globe. And in the sessions, till then, bye bye. Be ready for the best and get ready for the best. Bye bye. I welcome you all. In this session, we shall understand the entire overview of this financial modeling course. So if you have already decided that you are going to take this course, you can simply skip this session. And if you are still in the process whether to take this course or not, you can see the entire overview, and based upon you can finally take your decision. So in this course, we shall try to find out our financial model. Now, for our financial model, it depends upon our weighted average cost of capital and our projected financial statement. And our weighted average cost of capital depend upon our cost of equity, cost of debt. And our projected financial statement are our income statement, balance sheet, and cash flow statement. So we shall compute all these things. So we shall start our discussion with finding the cost of equity using Gordon's growth model. So we will prepare one Excel sheet which shall reflect the Gordon's growth model. Now, inside this Excel sheet, we shall find our dividend growth rate first. Once we have found our dividend growth rate, we shall find our cost of equity using Gordon's growth model. Once we have done the Gordon's growth model, we will find our cost of equity using CAPM model. And for CAPM model, we would require our expected return on market. And we shall find our expected return on market from these particular details. Along with that, we would need the beta, which means the systematic risk for any particular company. So we shall find the beta, and also we shall find the beta using different methods. Once we have done that, we shall simply find our cost of equity using CAPM method, that is our capital asset pricing method. Once we have found our cost of equity, we shall simply go and simply see our equity value for overall company. After that, you can see that we will find our cost of debt. For finding the cost of debt, we will go to our debt sheet and try to calculate it. After that, we shall model our tax rate as you can see here. This tax rate shall be modeled. Once our cost of debt and cost of equity has been calculated, we shall go and find our weighted average cost of capital. So we shall go and find our overall weighted average cost of capital for our company Caterpillar Incorporation as you can see here. Once we have done that, we shall simply go to our financial model. And inside our financial model, we already know that firstly, we would need historical financial statement and their ratios. For that purpose, we shall prepare our income statement, which is based upon historical details from the year 2016 to year 2020. This income statement shall be prepared based upon annual report. And similarly, we shall prepare our cash flow statement, which is historical details. And along with that, we shall prepare our balance sheet based upon historical details. And finally, we shall rewrite our balance sheet for our analysis purpose because we would need some rewritten items. After that, we shall go and analyze the sales for our company Caterpillar Incorporation. After that, we shall go and find our current assets to sales ratios and our current liability to sales ratios. Once we have done that, we shall find our operating cost to sales ratios for our modeling purpose. After that, we shall model our fixed assets for Caterpillar Incorporation. As you can see, we shall model the depreciation rate and our property, plant and equipment to sales ratio. After that, we shall model our dividend also. And once we are done that, we shall simply go and model our other long-term liabilities and pension for the company. Once we have done that, we shall do our tax analysis here also. And after the tax analysis, the remaining certain ratios about the company shall be calculated. Once we have done all that thing, we shall go to our financial model as you can see. This whole financial model is Proforma financial model which shall cover all the major ratios for our projection. Now, we shall start our projection with our year 2021 and till year 2025. So, we shall project our income statement for the future 5 years as you can see. We shall project our balance sheet for the next 5 years as you can see here. And after that, we shall project our cash flow, which is free cash flow for the next 5 years starting from the year 2021 to year 2025. And after that, finally, we shall find our intrinsic value of the share as you can see here, the intrinsic value which is 193.13. And once we have found the intrinsic value, our buy and sell recommendation can be given. And this whole report shall be presented in Microsoft Word format because our projections have been done in Excel. And if your client need these details in Microsoft Word report, we shall simply provide it in that report. So this shall be our overall structure and overall path. I see you in the next session from where we shall start our discussion. Till then, bye bye. I welcome you all. In these sessions, you can practice the whole financial model along with me. For that purpose, I have provided you the blank sheets for calculating the numbers along with me. So you can simply use these sheets along with the sessions while I am guiding you. And when you use these sheets, you can simply feed the details as I am feeding so that you understand the basics that how the financial model will work. Definitely, the humans learn more by doing. So I would suggest strongly that only you should not watch these sessions, but at the same time, you should practice along with me. So I see you in the next sessions when you shall be practicing along with me. Till then, bye bye. I welcome you all. In this module, we shall learn firstly about the basics of Gordon's growth model. After that, we shall try to find out the historical dividend details for Caterpillar Incorporation. After that, we shall find the dividend growth rate for the Caterpillar Incorporation using the previous 10 years data of dividend. And lastly, we shall calculate our cost of equity using Gordon's growth model. I see you in the next sessions. Till then, bye bye. I welcome you all. Let's try to find out our cost of equity using Gordon's growth model. Inside Gordon's growth model, we can simply say that the cost of equity, that is KE, is equal to our D1 upon P0 plus G. Now these numbers will be calculated and found in the real world. D1 reflects our expected dividend per share in the next year for Caterpillar Incorporation. P0 reflects the current market price of share on the date of valuation for Caterpillar Incorporation, and G simply reflects the dividend growth rate based upon historical trends and details. These numbers shall be calculated based upon the real world data, which we shall see in our forthcoming sessions. So we will find our D1, our P0 and our G in the forthcoming sessions. I see you in the next sessions. Till then, bye bye. I welcome you all. Let's try to find out the historical dividend details of the company. For our analysis, we have selected Caterpillar Incorporation. So I write Caterpillar Incorporation dividend history, and when I get the results, we can see that there is a section or a link named as investors.caterpillar.com. This particular link is the official website for caterpillar.com. And when you go and see this website, you can see that they have provided the dividend details for 2021, 2020, 2019, and all the previous years. Now, what you can do, you can just take the details of dividend from here and copy and paste these details into Microsoft Excel. Or there are certain other websites which compile all the dividend details from any particular company. So if I go back and I see one another website named as streetinsider.com, and when I click over that, we get the dividend history for Caterpillar Incorporation here. Now this website is providing all the compiled details of dividend for the Caterpillar Incorporation for all the previous 10 years from 2011 to, as we can see, it's 2021. So what we will do, we shall copy these details of dividend from here and we shall paste these details into our Excel sheet. After pasting it, we shall start our analysis. For that analysis, I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out the dividend growth rate. For finding the dividend growth rate, we already know that we have taken the dividend details of the company. And after taking these details, I have prepared one Excel sheet for you. Now, many of the analysts think that the dividend can be calculated and the growth rate can be calculated for whole period of the company. That is, since the inception of the company, what is the growth rate of dividend for the company? While many other people think that the dividend growth rate can be considered only for the previous 5 years. Because previous 5 years represent the majority of the recent trends. So based upon that, I shall show you the growth rate based upon previous 10 years also and based upon previous 5 years also. Now, you may see that there is some error inside this formula. So these are not the errors. Once I shall feed the data inside this yellow blank area, we shall get our results. And once we get our results, I shall show you how to interpret those results. So if I take the details of our date and the amount of dividend, I paste these details here. So we get our growth rates here. Now, how I have calculated these growth rates is an important thing. If you see that our whole period include the details from July 2011 to July 2021. So this is a period of 10 years. In this period of 10 years, if you see that these details belong quarter wise. So you can see that dividend was paid in July, then October, then January, then April, then July, then October, then December, then April, and then July again. So the dividend pattern for Caterpillar company is quarterly. And if you see the dividend, then there are total of 41 times the company has paid dividend in the previous 10 years. So it means that if I want to calculate quarterly growth rate, how we can do that? We can simply select the formula inside the Excel. Now, you will say that I don't understand how the growth rate formula has been used. And I tell you one more thing again, that these sessions are for those people who already know some intermediate knowledge. If you don't know how to calculate the formula of growth rate, I have provided a separate appendix after these sessions so you can see that how these have been calculated. But for the time being, my goal is to let you understand the financial modeling, calculation of annual growth rate, and calculation of WACC. The interpretation is being done here, and after interpretation, if you don't understand the formulas, then you can see the appendix section. Now, showing that there is a 40 period time here. 40 period time means that there are a total of 40 quarters in these 10 years, because every single year have total of 4 quarters. Now, if we try to convert this quarterly growth rate into annual growth rate, we shall simply use the quarterly rate to the raised to power 4, because every year have 4 quarters. So if you see this 9.21%, this is the annual growth rate of dividend based upon the historical dividend data of previous 10 years. But majority of the analysts think that the recent 5 years reflects more latest growth rate. So many of the people use the 5 years data also. And if you see that how the 5 years growth rate has been calculated, so you will say that this B43 divided by B23, and if you go here, you will see that this is the dividend of 2016, which is $0.77, and there is another dividend which is latest dividend is 1.11, which is in 2021, which means that we have seen the growth rate from 2016 to 2020 for 5 years. Now, if you see that this is there are total 20 periods here. Why 20 period? Because in the 5 years there are 4 quarters in each year, so there are total 20 quarters, and the quarterly growth rate in the recent 5 years is 1.85%. Now if we try to convert that quarterly growth rate into our annual growth rate, you will see that again I have used the quarterly rate and it raised to the power 4 for getting the annual growth rate. This annual growth rate 7.59% is representing recent trending growth rate. After calculating this growth rate, we shall use these details in our major Gordon's growth formula. And along with that, if you see our chart, you can see a good pattern that the dividend has been increasing from 2011 to 2021 in the recent period. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to calculate the cost of equity using Gordon's growth model. For that purpose, we would need the formula specifically, as we know that cost of equity is equal to D1 upon P0 plus G. For that purpose, I have written the P0, that is the stock price. Now, this stock price has been taken from Yahoo Finance, as you can see. This is Caterpillar Incorporation, and this is the stock price on Yahoo Finance for Caterpillar Incorporation, which is 193.13. So I am writing it here, 193.13. After that, we already know that we have calculated our quarterly dividends. So our quarterly dividend for the last quarter ended as on July 21 was 1.11. We have written it here. Now, you already know that cost of equity for any company would be on annualized basis. So we shall multiply this dividend with the number 4 so as to convert this dividend on an annualized basis. Also, we have computed our dividend growth rate for previous 5 years and 10 years, which we shall be writing from our previous calculation which is I can write for previous 5 years it's 7.59%, and for previous 10 years we have calculated it, which is 9.21%. Now after that, we simply need to use our Gordon's growth model formula. So what we will do, we know that this is our D0, that is current year dividend. We shall convert this D0 into D1 by multiplying it with 1 plus growth rate. And once we multiply this number, you will get your D1. And after that, you shall divide your D1 with the price of stock, that is P0. Once you divide that price, after that we simply need to add our growth rate into that for 5 years, which I am writing here. Once we do that, we will simply get our Gordon's growth model cost of equity, which is 10.06%. In the similar manner, let's try to compute the 10 years cost of equity for using the Gordon's growth model. So we will write again, this is D1, and we shall multiply this D1 with 1 plus growth rate of 10 years. And after that, this shall become our D1, and we shall divide this number with the price, that is P0. And once we divide with the price, lastly, we shall add inside it our growth rate, which is again 9.21. And if we press enter, we shall get our cost of equity using the Gordon's growth model, which is 11.72%. Now, for many of financial analysis, the recent trend details is being used for cost of equity. So in this case, while calculating weighted average cost of capital for the company, we shall use the KE, that is cost of equity, for 5 years detail based upon. And after that, we shall calculate our weighted average cost of capital. So I see you in the next sessions. Till then, bye bye. I welcome you all. In this module, we shall learn the basics of expected return on market index. After that, we shall understand and download the historical data for market index S&P 500. Next, we shall understand the basics of beta, that is systematic risk in the stock market. And after that, we shall download the historical data for calculation of our beta for Caterpillar Incorporation. Next, we shall calculate and understand the basics of CAPM model, that is capital asset pricing model. And lastly, we shall try to find out our cost of equity using CAPM model. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to understand the capital asset pricing model or CAPM model. For calculating the cost of equity under capital asset pricing model, the following equation can be used, which is RF plus RM minus RF multiplied by beta, where RF means risk-free rate of return. It means that whenever you invest in certain government treasury securities or government treasury bonds, what is the return those government treasury bonds provide you is known as RF, risk-free rate of return. The RM represent the return on market, which means that if you invest in any stock market index just like S&P 500, and what is the return provided by that S&P 500 stock market index is known as return on market. And lastly, beta represents the systematic risk, the risk which is on the stock due to the economy, the risk which cannot be avoided, and the risk which is very different based upon company to company and industry to industry. Using these details, we shall try to find out our RF, RM, and beta, and finally our cost of capital in these sessions. I see you after this session, and let's try to find out our all details in a realistic world. Till then, bye bye. I welcome you all. Let's try to find out our expected return on market. For finding our expected return on market, we shall go on investing.com, or you can choose some other website also. On this website, I shall go on S&P 500 index. Now S&P 500 index is representing the stock market. So we shall try to find out our expected return on this index. So if I go down, you can see there is one section which is representing historical data. I shall click on this historical data section, and once I click on them, you can see that this details are given here. Now, this S&P 500 historical data is on a daily basis here, and I would need the details not on daily basis but on a monthly basis. So I can choose the monthly basis, and I want to check the historical data for all the period since 1980, because I want to check the return on market for S&P 500 since 1980. So I go and I choose the year 1980. And based upon that, if I apply my filter, you can see that the prices for all the months since the year 1980 have been reflected here. Now, what we shall do, we shall simply download this data and use this data for finding our expected return on market. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to understand the basics of expected return on market. Expected return on market is simply the return which the investor would expect to receive from the broad stock market indicators such as S&P 500 index or any other index. What does it mean? It simply means that if you go to Google and type S&P 500, and inside that if you choose 1 year, you can simply see that you have received a return of 29.30% on investment in this S&P 500 for 1 year. So we would require our expected market return based upon the previous year's details, and these details shall reflect our ERM, that is expected return on market. Definitely, these sessions are built for those people who already know the basics of finance and who really want to advance their career in financial modeling and understand these concepts. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to calculate our expected return on market on Excel. As we know that from our previous discussion, we have downloaded the price of S&P 500 index from the year 1980 till the year 2021. So these are the prices and the date. Now, if I copy these prices and the date inside our sheet data, we shall get our results. Now, we shall try to interpret our results, and based upon that interpretation, we will get our expected return on market, which is ERM. Now, if you see that this number is representing that on October 1st, the price of S&P 500 was 127.47, and on 1st November 1980 it became 140. So how much percentage increase was there in the 1 month? So you can simply say it was 10.24% increase. Similarly, from November to December, how much increase was there? From December to January, and this pattern has been used till the end of 2021. And once that has been calculated, an average of all the monthly return has been calculated, as you can see. And based upon that average of monthly returns, we have calculated simply our annualized return by multiplying the monthly return with the number 12. Now, this annualized return is showing our expected return on market, that since 1980 on an annualized basis the company has received, or this S&P 500 index has received, an annualized return of 9.85%. I would like to let you know that these annualized returns have been calculated based upon simplicity and respecting the monthly valuation. If you want to calculate exact precise annualized returns, those returns can be calculated using the natural log system. However, I would suggest at this stage you should use the basic annualized returns as I have calculated. I will also show you the natural log annualized returns also in the similar sheet or in another lecture, but I would suggest not to use that but to use the generalized annual return. This annualized return of 9.85% is representing our expected return on market because this return is being provided by the market. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to discuss the expected return on market on the natural log basis. Now, I won't go into the derivation of these natural logs, but for your understanding, the natural log formula in Excel is being used as ln. And if you use this ln formula, this returns the natural logarithm of a number. So for calculating the returns, this time I have used the formula ln, that is the natural log. And when I have used the same natural log formula for all the returns, our annualized return has been changed. Now, if you ask me which method for calculating the expected return on market should be used, should we use the current method or should we use the previous method? I would suggest if you understand the natural logarithm, then you can use the current method where I have used the logarithm formula for calculating the monthly returns. Or if you don't understand the natural logarithm, and these sessions are made for your basic understanding of financial modeling, you can simply use our previous formula, which was just like monthly increase without using the natural logarithm. I would suggest, and in the forthcoming session, I will be doing my calculations not based upon natural log but based upon general expected return calculation. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to understand the meaning of beta. Beta represents the systematic risk of the economy. As we already know that COVID-19 has hit the economy globally, so that is representing a systematic risk, which means that a risk which arises and affect the company or a group of companies in a systematic manner. Beta is also the measure of the stock's volatility in relation to the overall market. And the market index such as S&P 500 has a beta of 1. Now, the interpretation of beta is like this. If you see the Caterpillar Incorporation or any other company and the company has a beta of 2, it means that whenever the stock market shall change by 1%, stock price shall change by 2%. It means that it's the representative of volatility. So assume a stock who is having a beta of 5, which means that whenever the stock market shall change by 1%, the price of that stock shall change by 5%, which is having a very big impact on the stock. So beta is simply representing percentage change of stock due to the change in percentage of market index. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out the beta of Caterpillar Incorporation. For finding the beta, we would need percentage change of market price of Caterpillar Incorporation versus percentage change of stock market prices. For that purpose, we shall go to investing.com again. And on investing.com, we shall find the company Caterpillar Incorporation, as you can see here. Inside the Caterpillar Incorporation, we shall go to historical data. And when you go to historical data, again, there are different analysts who can take different number of periods for identifying the beta. But majority of the analysts always take the beta based upon historical prices of 5 years details, because recent 5 years reflects more representative numbers of the economy and the stock. And from this Caterpillar Incorporation, you can simply go to the time frame, or can you wait for a second, and you can simply go to the time frame and you can choose the monthly details. And from the monthly details, I'm just going to select previous 5 years period data. So from 2016 to 2021, I'm selecting the data, and These are my details about the price and the month alongside that. Once I have found that, I shall download these details, and after downloading these details, we shall put these details in Excel. In the similar manner, our market return would be S&P 500. So I can simply write S&P 500, and based upon S&P 500, this is the representative of stock market. You can choose some other index based upon your country, and I choose the S&P 500 index. Now, if I go to S&P 500 index and if I choose historical data, we shall again take the details of previous 5 years only, because we really need to know the scenario of economy in the recent period. So when we go to S&P 500, and I can simply choose the, instead of daily data, we can simply write here as you can see monthly data, and from here we can simply write it's 2016 to 2021, and when I apply this thing, we can simply download these details also. And after downloading these details, we shall put these details into our Excel sheet, and based upon that, we shall see how to calculate beta. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out the stock beta in Microsoft Excel. As we already know that we have downloaded the stock prices for Caterpillar Incorporation and also S&P 500 prices for all the previous 5 years on a month-on-month basis. Along with that, I have prepared some Excel sheet for you, and inside that sheet we shall feed these details, and based upon the output we shall interpret our numbers. So let's go, and I shall copy these details, and after copying these details I shall just go and paste the details here. Now, after pasting the details, you can see that there is one another column which is showing the returns. If you see these returns are month on month basis for Caterpillar Incorporation, as you can see here. Also, the return for S&P 500 on month basis has been computed here. Now, for calculating the beta, there is a specific formula in Microsoft Excel. The formula is of slope. So if you use this formula equals to slope and try to calculate the beta, you shall select all the return details for Caterpillar Incorporation and the return details for S&P 500, and if you use this formula, we shall get our beta, which is 0.8909. The interpretation and the meaning of this beta is that whenever there is a 1% change in S&P 500 returns, the Caterpillar stock changes by 0.8909%. This is a basic interpretation. Now, there is another way also through which we can calculate and find our beta. As we already know that for finding the beta, we can use this formula of covariance between the Caterpillar and S&P 500, and we can divide it by the variance of S&P 500 and we get the beta. Now, if you don't understand what is a covariance and variance, I tell you again that for referring these things, you can just go to our appendix section, and there are all the description of these words. Because at the moment, we are just trying to find and analyze how we are getting and what are the interpretation of these numbers. So if you see that I have calculated the covariance, and for calculating covariance, there is a specific direct formula which you can see. The formula is like covariance, and I have again selected the details of Caterpillar Incorporation and S&P 500 through which I got the covariance. Covariance simply reflects the relationship between the stock return and the market return. And after that, I have calculated the variance using the formula var.s, and I have used the variance of stock market S&P 500. And once we have done that, we simply use our formula covariance divided by variance, and we get our details of beta. So you can see it's J3, which means 0.0017 divided by 0.0019, and we got our beta of 0.8909 again. So there are different ways through which we can find our beta, which reflects the systematic risk of stock. We shall definitely understand these concepts more and how to use this beta for calculating our CAPM equation. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out the beta using the regression features in Microsoft Excel. If we go to our data, we are already having our details about the prices for S&P 500 and the prices for Caterpillar Incorporation. Now, if we want to use the beta and we want to use the regression function in Excel, what we will do, we will go into the data tab, and inside the data tab, there is a section named as data analysis. If we click on the data analysis, you will see that there are different data analysis features. And inside this data analysis, if you go to regression, you will select it. Once after selection of it, you will get a pop-up menu, and inside that pop-up menu, you need to input the Y ranges. Now inside the Y ranges, select the return details for Caterpillar Incorporation, and inside the input for X range, select the, I can say, select the S&P 500 details. Once you have done that, your output range needs to be selected, that at which place you want to select and get the results. So I'm selecting my output range as I3 or I4, whatever you want. So I have selected I4. And if I click on OK, you will see that we will get some results. Now, these results are in the form of months, but I need these numbers in the form of numbers. So I'm just going to my home tab, and on my home tab, I am just finding my numbers. Now, if you see this coefficient is 0.8909. Now, this coefficient is same as our beta, as you can see above. Our beta is also 0.8909, as you can see here. So for calculating beta, you can either use the slope function inside Excel as we have seen in the earlier sessions, or you can use the regression function for finding the details of this beta. This beta is 0.8909. Now, in the further sessions, we shall be using this beta for computing our cost of equity using CAPM model. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to compute the cost of equity using CAPM model for Caterpillar Incorporation. For that purpose, we shall go to our Excel, and inside that, we already know that we have calculated the beta for Caterpillar Incorporation. The beta details are here as 0.8909. And after the beta, we would need risk-free rate of return. For finding the risk-free rate of return, we will go to one website, that is www.treasury.gov. You can also use some other sources for finding the risk-free rate. Now, there are different yield rates has been given, from monthly yield rates to the yearly yield rates. And for our calculation purpose, majority of the people or different analysts take any of the yield rates based upon the best suitable criteria. For our analysis purpose, we shall take the risk-free rate based upon 10 years yield, which is 1.49, as you can see. These rates keep on changing, so based upon those changes, we can take our different assumption. And yes, this all depends upon analyst study and research about the company. After that, we have already calculated our expected market return. So our expected market return, if we go, and our expected market return is 9.85%, which you can see right now. Once we have computed that, we can simply find the cost of equity for Caterpillar Incorporation. For that purpose, we will simply use our formula or equation, which is RF plus RM minus RF multiplied by beta. So I'm writing RF plus, I'm writing RM minus RF, and then I'm multiplying it with beta. Wait for a second, I'm multiplying the number with beta. So we are getting the cost of equity for Caterpillar Incorporation. This cost of equity shall be used for finding our weighted average cost of capital for overall company in the forthcoming sessions. I see you in the next sessions. Till then, bye bye. I welcome you all. In this module, we shall learn about the meaning of cost of debt. After that, we shall try to find out the before tax cost of debt for Caterpillar Incorporation. After that, we shall analyze the tax rate for the company. And lastly, we shall find after tax cost of debt for the company. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to understand the meaning of cost of debt. The cost of debt simply means that how much interest we need to pay while we have borrowed certain amount of debt. So, for calculating the cost of debt, that is KD, there is a specific formula which is I multiplied by 1 minus tax rate. For example, if a company has issued debentures worth of $1,000 and the interest rate is 10% and the tax rate is 30%, so the cost of debt would be 10% multiplied by bracket 1 minus 30% is equal to 7%. This 7% shall be used as the cost of debt while calculating our weighted average cost of capital. In the coming sessions, we shall try to find out cost of debt for Caterpillar Incorporation. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to compute the cost of debt for the Caterpillar Incorporation company. For that purpose, we would need certain details in the form of our short-term debt for the company, long-term debt for the company, and interest expenses for the company, along with tax rate. For this purpose, we would need the annual report where we can go and find the short-term debt and the long-term debt of the company. For that reason, we shall go to the website of Caterpillar Incorporation. On that particular website, inside the investor section, we shall go to SEC filings, and inside the SEC filings, we shall choose the year 2021 because the annual report for the year 2020 is being presented in the year 2021. And if you find the annual report, we can simply go and see that the annual report 10K is here. And after that, I can simply download the Excel version of this particular sheet, and you can simply see that this is getting downloaded. So if I click on download, you will see that this file has been downloaded. After downloading it, when I try to open it, you can simply see that inside the sheet, the details about all the annual report content is given. And our purpose is to find out short-term and long-term debt. So inside the balance sheet, if we go, this is the balance sheet. Let me increase the size of the balance sheet. And when we increase the size of the balance sheet, you can simply see that assets and liabilities are written. Now, inside the liabilities, we can simply see that the short-term borrowings about the machinery and financial product is given. So these are two items about our short-term borrowing. So I'm highlighting those two numbers. Also, if we go further, we can simply see our long-term debt, which is due within 1 year for machinery and financial product is written here. So this number shall also be used for our cost of debt purpose. And after that, if we go and see long-term debt due after 1 year for machinery and financial products is here, as you can see. So let's start using these details for the year 2020. Now, if we go to our project model, you will see that short-term debt for the 2020 is needed to be written. So as we know, the short-term debt is $10 and $2,005 here. So I can simply add 10 plus 2,005, and this is our short-term debt. After that, we go and see that these are our long-term debt, although you can simply say that this long-term debt is due within 1 year. So It all depends upon how you want to show it. If you want to show it within the short term debt, that's also fine. If you want to show this for the long term debt, that's also fine, because our total cost of debt depend upon both short term and long term debt. So if I use these numbers and I try to write it inside our long term debt, you can simply say that it's the part of long term debt. So it would be better to represent it inside the long term debt, which is 1420. And then if I add 7729, it's 7729, and after that we can simply say it's 9749, it's 9749, and lastly we can see our long-term debt is 16,250, so it's 16,250. So if we add all of these, we get our long-term debt. Now you could have also shown this long-term debt which was due within 1 year inside our short-term debt amount. But at the end, we would need our total debt for the purpose of our cost of debt calculation. So this is our total debt, which is our final amount for calculating the cost of debt. Now, after that, we shall go and try to find out the interest expense for the Caterpillar Incorporation. For that purpose, we shall simply go to its income statement. And inside the income statement, this is not the income statement. I think that they have provided the wrong linkage here. This is the income statement for the year 2020, as you can see here. Inside the income statement of 2020, if we go, we can simply find the interest expense of the company for the year 2020 as 589. Now, if we show these numbers are $589 I have written. Now, one more thing, that all these numbers are in definitely millions, as you can see. So I'm not talking and saying that these are in millions, but I'm using the general dollar word. Now, after that, we need to find our cost of debt before tax. So it's simple that you have an interest expense of 589 on an overall debt of 37,163, which brings you the cost of debt or your average interest expense before tax as 1.58%. Now, this thing has been calculated for the year 2020, and once we calculate this for the year 2020, we can similarly calculate the same thing for all the years, that is our 2019 and 2018, for the modeling purpose. Now, once we have done and found these details from the previous annual reports of the year 2019 and 2018, we will simply go and find out our average rate here. So you will say this is our average model cost of debt before tax. And once you would calculate the tax, we will simply make this rate after taxes so that we shall be able to find the Caterpillar's cost of debt after tax. And before that, as you know, that you need to see some further sessions that how I have calculated the tax rate for the company. And lastly, when we shall try to model our cost of debt, I shall convert this before tax cost of debt into after tax cost of debt at the end. But for this particular session, you have understood about how to calculate the model cost of debt before tax. I see you in the next sessions. Till then, bye bye. I welcome you all. Let's try to model and compute our tax rate for Caterpillar Incorporation. As we already know that for calculating the tax rate, we will need income before taxes and our tax expenses so that we can calculate the tax rate. For that purpose, we shall go to our income statement of Caterpillar Incorporation for the year 2020. Inside that, we will go and try to find out the profit before tax. As you can see that this is the consolidated profit before tax for the year 2020, which is 3,995, and I shall take this number 3,995. And after that, we need to see the tax expenses, and the tax expenses for the year 2020 is simply 1,006, as you can see. So I shall simply write 1,006 here. After that, we can simply calculate our implied tax rate from this number, which is 25.18% for the year 2020. In the similar manner, we shall take the details for the year 2019 also and 2018 also, and we shall get the implied tax rate for those periods also. Now, You need to understand this fact that tax rate should be taken as the latest year's tax rate because tax laws keep on changing and the latest year tax rate is more likely to be prevailing in the future periods. So instead of taking the average of these 3 years tax rate, we will model and assume our model tax rate as let me convert this thing into a number and then percentage. So we will assume our model tax rate to be 25.18%, which is for the latest year 2020. This tax rate shall be used for our further calculations and our other details. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out the after tax cost of debt for the company. In the previous sessions, we have calculated the cost of debt before the taxes for the company and we have calculated the tax rate also. So this is our cost of debt before the taxes. Now we simply need to convert this rate into after tax rate. So I will write 1 minus simply our tax rate which we have calculated, and this number is our model cost of debt after tax. This cost of debt shall be used for our calculation of weighted average cost of capital. So this is model cost of debt I am writing after tax. This number shall be used for all the details regarding WACC calculations. I see you in the next session. Till then, bye bye. In this module, we shall learn about the basics of weighted average cost of capital, and after that, we shall try to find out the weighted average cost of capital for Caterpillar Incorporation in the real world environment. I see you in the next sessions. Till then, bye bye. I welcome you all. Let's try to compute our weighted average cost of capital, which means WACC. For calculating WACC, we simply need the weight of debt, which is debt upon debt plus equity, and then we multiply this number with the cost of debt. In the similar manner, we calculate the weight of equity, that is equity value divided by debt plus equity, and then we multiply this number with the cost of equity. In this way, we get WACC. For example, if a company has a cost of debt KD of 10% and KE of 13%, alongside debt is 1000 and equity is 2000. It means that inside the capital structure, the total value is 1000 plus 2000, that is 3000. Now, how you compute the WACC? Then simply it's the weight of debt, that is 1000 divided by 3000. This is the weight of debt. We multiply this weight with the cost of debt of 10%. Similarly, we calculate the weight of equity, which is 2000 divided by 1000 plus 2000, which is 3000. So 2000 divided by 3000 bought us the weight of equity, and we multiply this with 13%, which is cost of equity. And when we add both of these numbers, we get our 12%, which is our weighted average cost of capital. In the similar manner, we shall calculate this WACC for our Caterpillar Incorporation. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to compute our weighted average cost of capital for Caterpillar Incorporation Company. For that purpose, we shall go to our Excel sheet, and inside our Excel, firstly, we will write our outstanding number of shares. Now, for finding our outstanding number of shares, we shall simply go to our Yahoo Finance again. And on Yahoo Finance, we can simply see the shares outstanding quantities 547.47 million. So I'm writing here 547.47 million as number of shares. After that, we can write the share price for the company. So share price for the company, as we know, it's 193.13 right now. So I can write 193.13 as share price. Once we multiply the number of outstanding shares with the share price, we will get the equity value for the company. But I would like to write these numbers in billions, so I would divide the number with 1000, and this number is 105.73 billion. This is the equity value for Caterpillar Incorporation, and you can see the same market value 105.73 billion for the Caterpillar Incorporation. After that, we need to write our net debt, which you already know that we have calculated the net debt in our cost of, I can say, in the cost of debt sheet. Inside that, for the year 2020, we already know that our net debt is 37,163 million. Now, we also need to convert this number into a billion number, so I'm dividing it with 1000, and once I press enter, our net debt is 37.16 billion. After that, we can simply take our tax rate. We already know we have computed our tax rate from, as you can see, from our original sheet, it's 25.18%. And after the tax rate, our cost of debt after tax has been calculated. And we know that already our cost of debt after tax has been calculated initially, which is here 1.39%. After that, we can simply put and take our expected market return ERM. So our expected return on market ERM we have already calculated, which is 9.85%. And after that, we can simply write our risk-free rate. But we have calculated and found our risk-free rate while we were using the CAPM, and this risk-free rate is 1.49% here. So I just write it here. And lastly, we can put our equity beta, which we have calculated as 0.8909. Now, these whole details consist of our details required for financial modeling. Once we have done that, we can simply try to find out our weighted average cost of capital. So we have calculated our WACC based upon two methods. That is, one method is Gordon's growth model method and another is CAPM method. So let's try to find the WACC, or weighted average cost of capital, what we call it. So our cost of equity RE we already know based upon Gordon's growth model. So our cost of equity, as you can see, Gordon's cost of equity is 10.06%, which we have discussed that we will definitely use the previous 5 years details, and this is 10.06%. Now, for calculating WACC, you already know that you need to multiply the weightage of equity with the cost of equity. Then you need to add the weightage of debt with the cost of debt. So I will simply write the weightage of equity, which you can see 105.73 billion, divided by the total amount of debt and equity, which you can see is addition of the value of debt and the value of equity. So this whole number reflects the weight of equity for calculating our WACC. Now, if you multiply this weight of equity with cost of equity, this is the one number which we will get. Similarly, we need to add the weight of debt multiplied by the cost of debt inside this number. So we will calculate the weight of debt. For weight of debt, we shall take the amount of debt, which is 37.16, and we shall divide it by the total equity and the value of, I can say, debt. So this particular formula is showing the weight of debt right now. Once we calculate the weight of debt, we shall simply multiply this number with our cost of debt, which is 1.39%. And if we close down these brackets, we shall simply get our WACC, that is weighted average cost of capital, which is 7.81% using Gordon's growth model. In the similar manner, we shall try to find out our WACC using CAPM method. Our cost of equity, we already know using CAPM method is 8.94% right now. And after that, we need to calculate our weighted average cost of capital, which is WACC. And for calculating the WACC, we will again use the same thing, that weight of equity. So this will be the weight of equity value divided by the value of equity and debt. If we do this particular thing, as you can see inside the formula, you will say this is the weight of equity, and you need to multiply this weight of equity with the cost of equity. Once you do that, after you shall add and do the same thing for the debt. So you will simply say I shall find the weight of debt, which is B5 divided by the value of equity and the value of debt. If you add both of them, you will simply say this number is reflecting the weight of debt right now. And if you multiply this weight of debt with the cost of debt, which you already know, is 1.39%, and if you close the formula, you will get the result of WACC, that is weighted average cost of capital for equity, which is 6.98%. Now, this is an important thing that we have calculated our weighted average cost of capital for the company. For this particular reason, we have to take a call that should we use the WACC based upon CAPM method, or should we use the WACC based upon Gordon's growth method. Now, in majority of the finance theories and majority of the analysts give more respect and weightage to the WACC calculated using CAPM method. So for our further calculation, we shall take the WACC as 6.98% because all the finance theories give more respect and weightage to CAPM method, because that clearly talks about the systematic risk in the market, and CAPM method is the most widely used and acceptable method for finding the WACC. So from now onwards, our WACC shall be treated as 6.98%. And in this session, I have just shown you how you can calculate WACC using Gordon's method and also the CAPM method. I see you in the next session. Till then, bye bye. I welcome you all. In this module, we shall understand the basic format of income statement. After that, we shall download the annual report and income statement. Inside that, we shall prepare our income statement from the annual report. After that, we shall understand the basic format for cash flow statement. After that, we shall prepare the cash flow statement from the annual report. After that, we shall prepare the basic format for balance sheet, which shall be understood by us. And then we shall prepare balance sheet from the annual report. And lastly, we shall rewrite the balance sheet for our financial analysis purpose. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to understand the income statement format which we shall be using for our projection and our final calculations. So, this is the income statement of Caterpillar Incorporation. Now, inside this income statement, there are certain items of sale of machinery and power system, and then revenue of total financial products. Then total sale and revenue will be found here. After that, certain operating costs such as cost of goods sold, selling and general administration expenses, research and development expenses, interest expenses on financial products, goodwills which are intangible assets, and other operating income or expenses along with deferred income taxes will be returned. After that, we shall get our total operating cost in here. Once we get our operating cost, and from the total sales and revenue, we reduce our operating cost, we will get our operating profit. After operating profit, there are certain items as interest expenses excluding financial products. Because interest expense of the financial product has been included above, so remaining interest will be shown here. And after that, if there is any other income or expense will be shown here. After that, we shall get our consolidated profit before taxes. Once we get the consolidated profit before tax, we will calculate our provision or benefit for income taxes, and after that, we will have here profit of consolidated companies. Once we calculate this consolidated company profit, we shall add here equity in profit or loss of unconsolidated affiliate companies, which means some other companies in which we have invested. So those will be our affiliated companies, and we will also add our profit of consolidated and affiliated companies. So these are two different items, and then we shall reduce our profit or loss attributable to the non-controlling interest. Now, non-controlling interest means the people who are having the minority interest in the company. After that, we shall get our profit. Once we get our profit, we shall find our profit per common share, and we shall find our profit per common share based upon diluted EPS. After that, we shall simply write our weighted average common number of shares, which will be basic number shares and which will be diluted number of equity shares. And lastly, we shall write how much cash dividends we have declared per common share each and every year. These details shall be taken from the annual report, and based upon these details, we shall go further and project our income statement. Thank you. I see you in the next session. I welcome you all. For projecting any of the financial model, we require the future cash flows. And for getting the future cash flows, we would really need to understand the past cash inflows. And for understanding the past trends, we require three financial statement analysis. First statement is income statement, second is our balance sheet, and third is our cash flows. So for analyzing these previous financial statement, we will take previous 5 years data for income statement, balance sheet, and cash flow. In this section, we shall start with income statement. So for getting the income statement details, we shall go to our investors section on Caterpillar Incorporation website. On that, you shall find SEC filing, which means Security Exchange Commission filing. And if you click over that, you can simply see that there are financial statements for different years provided by the company. Now, as we know that the current year on which I am doing the analysis is 2021, and the financial statement for 2021 have not been prepared because the year has not been ended. So I can take the previous 5 years, which means 2020, 2019, 2018, 2017, and 2016. And as you know that if the company has been working in 2016, the financial statement or the annual report for 2016 shall be published in the year 2017 once the year 2016 has been completed. So if I go to year 2017, then there are different forms here, as you can see, and based upon that, if I find the annual report, you will find that we are having our annual report on 15th of February 2017. This is the annual report, and this is in the form 10K. What does this 2017 means is that you have prepared your annual report from the data of the year 2016, and this is published in the year 2017, 15th of February. And there are different formats in which these details or data have been presented by the company. So this is in PDF, RTF, Excel, and some other format. For our analysis purpose, we would need the details in Excel. So I have clicked on Excel, and once I have clicked on Excel, there's an option to download the Excel file, and I have now downloaded the Excel file, and this is getting download. So let's wait till it's get download, and it would take hardly around 10 to 20 seconds. Till then, you can see the preview of this particular Excel file here. Now, the file has been downloaded, so let's try to open this file, and I am opening this file, and this file is getting opened, and let's wait for a second, and this shall definitely get opened very soon. So I'm enabling editing here. Now, if you see the index of this file, you can simply say that inside the index of this file, there are income statement, balance sheet, and the cash flow, different things. Now, for our analysis, we would need the income statement. So I click on the income statement. If you see the income statement, I am just talking about the details for the year 2016. So these all are not the details of income statement because I think that they have a problem in linking their Excel sheet. So this is not the income statement. The income statement is inside this table 29, as you can see. This is the income statement which contains the sales revenue details, machinery sales details, other operating costs, and so on. So there is a linking problem of these sheets, but we know what is the income statement. So we will require these details for the year 2016, as you can see here. And once we have worked upon the year 2016, we will take the same details for 2017, 2018, 2019, and 2020. Now, I shall show you the filling of these details in our format, that how we really need to use these details for making and preparing our annual data report. And I shall download the annual reports of the company for 2016, 17, 18, 19, and 20, and I shall show you how I have feeded the data for the year 2020 and so on. I see you in the next session. Till then, Bye bye. I welcome you all. Now, we have downloaded the annual reports for the company for previous 5 years. Now, based upon the previous 5 years details, we shall prepare our income statement and we shall feed that data into our Excel so that our understanding can be increased and improved. So, for your reference, I have downloaded the financial statement or the annual reports of the company for the year 2020. I shall show you how we can use these details for year 2020 and based upon that previous 5 years. So I shall copy these details of annual report from the year 2020 and I shall just paste these details in here. Now, if you see that I have pasted the details here and can you wait for a second? Let me adjust it. Yes. So these are the details for the year 2020 and I have prepared these details into our format. So if you see that we are having the sale and machinery revenue of 39,022 and you can see the same sale and machinery revenue here. So what I have done, I have copied these details from this place to our income statement here and then I have taken other details also. So I'm just going one by one, or you if you want you can skip this session also because this will take hardly 1 minute, so you can simply understand it. So I have taken the revenue of financial products 2726 and this has been pasted here. After that our total sales and revenue has came here and after that you are having your selling your cost of goods sold 29,082 which have been pasted here, then 4,642 which you can see has been pasted here, then research expenses, then interest expenses, then other operating income or expenses, these have been pasted and finally we got our total operating cost of 37,195 which is being shown here. And after that, you can simply say our operating profit is 4,553, which is being reflected here. And after that, there are our interest expenses and other expenses, other income or expenses of 514 and 44, which have been pasted here. And after that, you can simply say our consolidated profits were 3,995 which have been pasted here and after that provision for income taxes and profit of consolidated companies have been prepared and pasted here. And after that you can simply see the equity in profit and loss of unconsolidated affiliated companies have been pasted here and after that you can see the profit of consolidated unaffiliated companies of 3003 have been pasted here. So in this manner, I have pasted and prepared this whole statement. And once I have prepared this statement is reflecting only the year 2020 details. Now, I would like to let you understand one more thing that you may have a doubt that why we are preparing the statement in this particular format. The reason is that I have prepared all my formulas based upon these FIDE data. So for making it more understandable for you, I have feeded and copy pasted these details in the Excel sheet in my format. So based upon this 2020 details, you can prepare the details for 2019, 2018, 2017, 2016, and you will see that whole of your, let me unhide these details, and you will say that whole of your details shall look like this, that you have taken the annual reports of all the 5 years, and once you have taken the annual reports of all the 5 years, you can simply see that you have feeded the details and all the feeded details are in our format for income statement. I hope you understand how we have taken the previous 5 years details here and based upon that we shall proceed and I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out the cash flow statement format and understand its way. Firstly, we shall go and try to find out the cash flow from operating activities. For that purpose, we shall take the profit of consolidated and affiliated companies first. After that, we shall adjust any non-cash items such as depreciation and amortization and any other items which is of non-cash nature. After that, there shall be an adjustment for changes in current assets and liabilities, which are in the nature of receivables, inventories, accounts payable, accrued expenses, accrued wages, customer advances, deferred income tax, any other assets, or any other liabilities. These shall be adjustment and these will be understood by you once we start working on them in the real world. After that, we shall get our net cash provided by or used for operating activities. After that, we shall start working on cash flow from investing activities. In the cash flow from investing activities, all the long-term investments which have been sold or purchased shall be shown here. So, if any capital expenditure excluding equipment leased to others will be shown here. So, expenditure for equipment leased to others, proceeds from disposal of any leased assets will be shown here. Addition to finance receivable, connection from finance receivable, proceeds from sale of finance receivables, investments and acquisitions, proceeds from sale of business and investments, proceeds from sale of any available for securities, investments in available for securities or any other investment. These items may be different for different companies because the basic nature of Caterpillar's business is quite different from other companies. So, if any other company exists, then the items in investing activities may change accordingly. After that, we shall get our net cash provided by or used for investment activities. After that, we shall go and try to find out our cash flow from financing activities. Now, in the cash flow for financing activities, all the financing activities just like dividend paid, capital raised, and so on will be shown here. So I'm just going through it. So dividend paid will be shown here, and distribution to non-controlling interest will be shown, and common stock issued, including any treasury securities reissued, common share repurchased, treasury share purchased, excess tax benefit from the stock-based compensation, acquisition of non-controlling interest, and there are a lot of other items which are of financing nature. So these items shall be taken in cash flow from financing activities, and again this may vary from company to company. So once we do that, we will get our net cash provided by or used for financing activities. After that, if we have some investments in foreign currency or we are going to receive some foreign currency, then effect of those changes in foreign currency needs to be shown here. Once we show it here, we simply have our increase or decrease in cash and short-term investments. After that, we shall add our opening cash and short-term investments so that we will receive our closing cash and short-term investment balance at the end. In this way, we will be preparing our cash flow statement for the purpose of projecting and predicting our projected financial statements. Let's come and try to practice these things in real world, and I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out the cash flow statement for Caterpillar Incorporation for previous 5 years. For that purpose, we shall go our annual report of Caterpillar Incorporation for the year 2020, and inside this annual report, we shall go to consolidated statement of cash flow for the company. And I shall copy the details for the year 2020 from the consolidated cash flow statement for you. And once I copy, and I shall paste these details here for your reference. Now, one thing I would like you to understand that there are different analysts who use different Excel formats for getting their model ready. Inside our model, I have not exactly used the cash flow statement prepared by the annual report of the company, but I have used this particular statement in some of my format. So I shall let you understand how I have used this data in my cash flow statement. So be with me. Now, if you see that the cash flow statement from the annual report is reflecting profit of consolidated and affiliated companies of 3003, and now you can see all this area is in white numbers because these all area is white. But if you see that there are numbers hidden here, as you can see, What I have done, I have colored these columns into white color. So I will unhide these one by one as we proceed further. So if you see that our profit and loss of consolidated companies is 3003, and I have feeded this data of profit of consolidated and affiliate companies 3003, and let me change the color of it, and it's 3003 right now. And after that, inside the cash flow, the depreciation and amortization is 2432, and this depreciation and amortization of 2432 is here. As per the annual report, you can see that there is one column of actuarial gain or losses on pension and post-retirement. But I have not prepared that thing here. I have prepared a column reflecting others. So we already know that we have used these two details. And after that, if we go to the others column, I have used two different numbers, if you can see. One is 1000 and another is 383. So this 383 is belonging to actuarial gain and losses, which I have used in others, and this 1000 is belonging to other cash flows, which needs to be added. So if I delete both of them, I have shown simply a total of both of those numbers as 1000 plus 383, which comes to 1383. And after that, there are other things which needs to be shown, which reflects the changes in current assets and current liabilities. So if you go and see that there is a item named as receivables of 1442, and inside this receivables I have used 1442, so you can use that directly. And after that, there is an inventory of minus 34, and inside the inventories, if you go, you can simply see that it's minus 34. And after that, if you go, there is accounts payable of 98, and inside the accounts payable, I am just showing this number of 98. And after that, there is something called accrued expenses of minus 366, and inside the accrued expenses, you can see it's negative 366. And after that, let's do it quickly. As you can see, there is an accrued wages of minus 544. There is an accrued wages of here minus 544, as you can see. And there is customer advances of 126 negative, and customer advances 126 of negative have been shown here. And after that, there is one item of deferred income taxes, which is here. You can see provision for deferred income taxes here, and which is 74 negative. So I have used this 74 of provision for deferred income taxes here, and I am just showing it here. Now, once I have done that, you can see there is an other assets of 201 negative. The other assets of 201 negative have been feeded here. And after that, there is an other liability of 686, and inside that other liability, I have provided the other liability of 686 here. And after that, if you adjust all of these numbers, if I show you the adjustment of all of these numbers, you can see the total is 6327, which you can see 6327 as net cash provided by operating activities, and I am using the black color here, so you can see the same number we have received. And after that, let's come to our investing activities. In the case of our investing activities, you know that there is a negative 978 of capital expenditure. So inside the capital expenditure, negative 978 has been shown. And after that capital expenditure, there is an expenditure of leases to others, which is 1137. And if you go expenditure of leases, I have shown 1137 here. And after that, there is a proceeds from disposal of leased assets of 772, and this 772 of proceeds from disposal has been used. And there is an addition to finance receivables of 12,385, and you can see there is an addition of 12,385 of finance receivables. So my format is majority or more than 90% similar to the statement prepared by the annual report of the company. However, I have made a little bit changes for my individual requirement of financial modeling. Every person has their own discretion, and every analyst have their own discretion how they can use these models. Now, if you go further, you can see collection from finance receivables is 12,646. And if I delete it, and there is a collection from finance receivable of 12,646 here. And after that, there is a proceeds from sale of finance receivable of 42, and then 111. And if I delete these two numbers, I can show you that these two numbers are 42 and 111. And after that, there is a proceeds from sale of business and investment, which is 25 and 345. And if I delete these two numbers, or let me show you individually, this is proceeds from sale of business of 25, and this is proceeds from sale of business of 25, and then proceeds from sale of securities is 345, and proceeds for sale of securities is 345, as you can see. And lastly, there is an investment in other securities, which is 638. And if I delete this and I show you, I have provided already investment in available for securities is 638. And lastly, there is an other section which is of 66. So I delete this 66, and inside this other section of 66, you can simply use it. Once you use it, you add all of these items, and you can simply say this number of negative 1485 is reflecting net cash used by investing activities, which you can see here, negative 1485, and this number I am showing you here. Now, finally, after that, we are having our cash flow from financing activities. For cash flow for financing activities, we are having our dividend paid of 2243, and this 2243 dividend paid is here, as you can see, 2243. After that, there is a common stock reissue of 229, and I can show you that there is a common stock reissue of 229. After that, common share purchased 1130. If you want to see 1130 common share repurchase here, this is your common share repurchase. After that common share repurchase, we can see that there are proceeds from the debt issue, original maturities greater than 3 months, and if you see that there is machinery and there is financial products, the number for them is 1991 and 8440. So you can simply show it as 1991 and your 8440. And after that, you are having payments on debt, original maturities which are having greater than 3 months, and you can see again machinery and financial products for 26 and 8211, and you can simply show these two numbers also here. Now, after these two numbers, you can see that there is short-term borrowings of 2804 and others as one. So I'm deleting this, and you can simply see that there is a short-term borrowings and others item of 2804 and minus 1. Now, after that, what would happen if you add all of these numbers? You will get your cash flow from financing activities. So if I delete this 3755 and I show it in the black number, you will say it's 3755. After that, there are other items just like net cash provided by the financing activities, your effect of exchange rate, short-term cash and cash equivalents at the beginning of the period, and finally cash and cash equivalents at the end of the period. And I have shown these all other items also inside it. So in this manner, we have prepared our cash flow statement for the year 2020. Now, in the similar pattern, if we download all the annual reports of the company from the year 2016, 17, 18, 19, and 20, that is previous 5 years, we can simply prepare our cash flow statement. So I am unhiding these details, and when I unhide these details, you can see that I have already prepared these details of cash flow for the company for previous 5 years, as you can see. These details are essential for any company for identifying and predicting the future cash flows. We shall use all of these details and the formulas in our forthcoming session for our financial modeling. Till then, we are preparing the details so that it would be easy for us to make our financial model. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to see and understand the balance sheet format for Caterpillar Incorporation. So, inside the balance sheet, firstly, we will write assets, and inside the assets, current assets will be written. Inside current assets, cash and short-term investments, then receivables of two nature. One is trade receivables and other is receivables for finance will be returned. After that, deferred and refundable income taxes will be returned, and after that, prepaid expenses and then inventories. In this way, we shall get our total current assets. And once we have our total current assets, we shall go and write our long-term assets such as property, plant and equipment, long-term receivables related to trade nature, and long-term receivables related to finance nature. After that, we shall simply write investment in unconsolidated affiliate companies, and after that, non-current, deferred and refundable income taxes, which we will be receiving. After that, intangible assets and goodwill and some other assets. In this way, we shall add our total current assets and our long-term assets so that we will get our total assets. After total assets side, we shall go to our liabilities side, and inside our liabilities, we shall firstly write our current liabilities. In the current liabilities section, short-term borrowings will be returned, machine and power system and financial products will be returned. After that, accounts payable, accrued expenses, accrued wages, customer advances, any dividend payable which are of current nature, any other current liabilities, and any long-term debt which is due within 1 year shall be returned here. After that, we shall do a total of all these current liabilities. Once we have done that, we shall simply write our long-term debt due, which is after 1 year for machinery and any other financial products. After that, liability for any post-retirement benefits, which is of long-term nature, will be returned, and any other long-term liability will be returned. Once we have done that, we shall add our total current liabilities and our long-term liabilities so that we will get our total liabilities here. After writing the total liabilities, we shall simply write our redeemable non-controlling interest shareholders equity, common stock, and after that treasury stock at cost, and our profits, and again accumulated and other comprehensive income. Lastly, we shall write non-controlling interest and our total shareholders equity we will receive. So we shall add our total shareholders equity and our total liabilities, and we will get our total liabilities and equity. In this way, we shall be able to prepare our complete balance sheet, and let's try to do the same thing in a practical manner. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out the balance sheet for previous 5 years for Caterpillar Incorporation Company. And for that purpose, we shall again go to our annual report for the year 2020. Inside that annual report, there is consolidated financial statement which is downloaded here, and I shall copy these details from the balance sheet and paste it into our financial model. Now, if you can see that these are the details. Now, let's try to fill the details in our financial model as per our requirement and convenience. So if you see, initially it's the cash and short-term investments of 9,352. I will show cash and short-term investment of 9,052 as you can see here. And in the similar manner, I can show the trade receivables, and for the trade receivables, there are two categories. One is trade and others, and another is finance trade receivables. And inside our format also, you can see these two columns are there. So I can simply show these two numbers also. And as you can see that our receivables have been shown here. After that, you can see that we are having some deferred and refundable income tax, and which is not here right now. So I have left this column blank. And after that, there is a prepaid expense, and next one is inventories. So I have taken both of these numbers, prepaid expenses and inventories, and we have pasted these numbers here. And after that, if you see, you will have a total assets of this particular number, which is our 39,464, and I delete this number from here. And after that, as we shall go for our other assets, there are certain property, plant and equipments. Then there is long-term receivables of two different categories. One category is for trade and other categories of finance. So if I take these three numbers, you will simply say these three numbers are similarly pasted or inserted here. And after that, you can see inside our financial model, there is investment in unconsolidated affiliate companies, but there is nothing like investment in unconsolidated companies in the balance sheet of Caterpillar Incorporation. So we are leaving this particular as blank. And after that, you can see we are having non-current, deferred, and refundable income taxes. These are the non-current deferred income taxes here, along with intangible assets, and then goodwill, and then other assets, which are in force sequence here. So we shall delete all these four items from here, and we shall simply highlight, or we shall appear these numbers here. Once you show these numbers, we will get our total assets, as you can see. So these are our total assets if we add our current assets and our non-current assets, which comes to, as you can see here, 78,324. This number is being shown here. After this particular number, we can see that there are liability section. Inside the liability section, there is one thing known as you can see, that there is certain short-term borrowings, but in the annual report, there is not anything like borrowing. So there is nothing like that. And after that, there is machinery, financial products, accounts payable, expenses, and accrued wages. And these are in the same sequence as required by our financial model. So these are in the same sequence. So I choose 1, 2, 3, 4, 5. These 5 items I delete from here and highlight these 5 items in our financial model. Now you can see here. After that, similarly, if you use the customer advances, dividend payables, or other current liabilities, long-term debt, other financial products, all of those items have already been done in the similar manner. So you can do one thing. If you want to fast forward, you can move to the next section also, but I shall take one more minute and then copy paste these details. So in the similar manner, if you choose all of these numbers have been chosen and provided from the annual report. So I am highlighting these all numbers, and these all numbers are here, which have been taken from the annual report. One thing I would like you let you understand that for making financial models, there are different people using different formats, different formulas, and I am using my format. As if you have seen the format till now, the balance sheet is having more or less 99% similar things. Your income statement was having more or less 99% similar things. Your cash flow statement was definitely having some of the items which were different from the annual report presentation, but majority of our statement are more or less similar. So now we have prepared and feeded our data for our balance sheet, income statement, and cash flow statement for all the previous 5 years. After that, these sessions we shall start analyzing these numbers, how these numbers have been derived, and based upon that we shall prepare our financial model. I hope you enjoyed these sessions till now. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to rewrite our balance sheet for financial modeling purpose. Why do we need the rewriting of balance sheet? Because so that it can help us for calculating multiple financial ratios, which are profitability ratios, our solvency ratios, our long-term solvency ratios, our liquidity ratios, and some other ratios. So let's start. Now, if you see my Excel here, I have prepared the rewritten balance sheet here. Inside that, if you see, the current assets is written. Now, inside the current assets, first item is cash and short-term investments. Now, if you see that I have taken the details of 9,352 cash and short-term investments from the original balance sheet which we have prepared earlier, and I can just show this number here, as you can see. After that, all the operating current assets will be compiled here. Now, in the balance sheet, every current assets, just like your debtors, your inventory, your prepaid expenses, all are shown independently. But for rewriting purpose, we are showing it here in a cumulative manner. So operating current assets, if you see, that I have selected all these operating current assets except cash and short-term investments here. So if I highlight them and I go to balance sheet re-return area, and you can see that all the current assets which are operating have been shown here. After that, we go to property, plant and equipment, and we can simply see that this number has already been provided. So I am highlighting which have been already been done. And after that, if we go and see, these are long-term receivables. Now, there are two categories of long-term receivables. If you see that I have added F13 and F14 from our balance sheet. So let's go to our balance sheet. Inside our balance sheet, you can see that one category of long-term receivables are our trade receivables, which is 1,185. The another category is of long-term receivables is our finance-related receivables, which is 12,222. And inside our balance sheet rewriting, we have shown the addition of both of them. As you can see, it's F13 and F14. So I can just highlight this and you find that these are our long-term receivables of 13,407. I also highlight them because these two have already been completed. Now, after that, let's proceed. If you go, you see that there are non-current, deferred and refundable income taxes. So these are only simple numbers, so I can just select it from the non-current, deferred and refundable income. And after that, if we go further, we can simply see that we are having our intangible assets, goodwill and other assets. Now, these three items are directly individually given in our balance sheet. So we can simply go to our balance sheet and take these intangible assets, goodwill and other assets, all these three items directly. So I am selecting all these three items directly because these are directly given in our prepared balance sheet. Now, after that, we will get our total assets, which is 78,324. And if you see our balance sheet, it's matching with our total assets because we have just reshuffled some of the data for our financial modeling purpose. Now, after that, if we go and see our liability side, inside our liability, I have written operating current liabilities. Now, I have selected a whole range of data from F27 to F32. If we go to F27 to F32, you can see all these data are our operating current liabilities of accounts payable till other current liabilities. And if I highlight them, I have selected all of them and the addition of all of them has been reflected in cell number F17 as you can see right now. After that, I have chosen the financial debt as a category. Now, inside the financial debt, you can simply see that there are a lot of items I have written. The financial debt includes all your short-term debts and your long-term debts. So you can see I have selected it F25, F26, F34, F35, F39 and F40. So let's go to our balance sheet and see those numbers. So if you see that there is short-term borrowings related to machine and power systems and then financial products. So this also is a category of our financial debt. So I select this financial debt and let me highlight it with another color. And this is our financial debt. Except that if you see there is a long-term debt which is due within 1 year, and this is also our financial debt. So I have selected this financial debt also. And after that, you can see that there is a long-term debt which is due after 1 year, and I select this financial debt also, which is in 39 and 40 row number. Now, if you add all these financial debt, this short-term debt, this long-term debt due within 1 year, and this long-term debt which is due after 1 year, you shall get our this number of financial debt. So we got our financial debt number. And after that, we can see there are two other items. One is liability for post-employment benefits, and another is other liabilities. If we show these two numbers directly, you can simply say that these two numbers are reflected here as you can see right now. So I select and highlight them, and you can simply see that these numbers are given. Now, inside the balance sheet, if I select these two numbers, you can see that yeah, I have shown these numbers. After that, if you do a total, you shall see these are your total liabilities which have been shown till now. After the total liabilities, let's go further and you will see that there is a stockholders equity. inside the stockholders equity, you will simply say that this particular stockholders equity contains common stock and treasury stock at cost. So these are simply F48. If I go to F48, we can simply see this is the common stock. So I highlight this and you just simply color it as 6230, and after that we can see that there is treasury stock at cost. So this treasury stock at cost can simply be used like this. I am showing it to you right now. You can say it's F49. So if you go to F49, you will simply highlight this also and show it in the re-return balance sheet. After that, you can simply see profit employed in the business, and then accumulated and other comprehensive income, and then non-controlling interest. These three items are individually written already in the balance sheet. So we highlight them and we go to the balance sheet directly, and these three numbers have been taken directly from the balance sheet if you see them. Now, after that, if you add these items, you will get shareholders fund or shareholders equity. And you go to rewritten balance sheet and you will simply say that this is our, I can say, total shareholders equity, which is matching with our original balance sheet, which is 15,378. Now, after that, if we so, you will say that our total liability and equity will be 78,324, which is also matching with our original balance sheet. So in this way, we have rewritten our original balance sheet. Now we shall use these rewritten numbers for calculating multiple financial ratios, and based on those multiple financial ratios, we shall keep on calculating our project keep on calculating and projecting our future cash flows. So I see you in the next session. Till then, bye bye. I welcome you all. In this module, we shall learn basically about the modeling of sales revenue, that how our sales revenue is growing. After that, we shall model our current assets and current liabilities to sales ratio. After that, we shall go and try to find out our net operating cost to sales ratio. And then we shall model our fixed assets to sales ratio. And then modeling of dividend will be done. And lastly, we shall model our taxes. So in this module, majority of our ratios will be calculated, which we shall use for our growth prospects and our financial modeling at the end. I see you in the next session. Till then, bye bye. I welcome you all. Let's discuss about modeling of sale revenue of previous 5 years for Caterpillar Incorporation. If I go to our Excel sheet, you will see that we are analyzing the sale revenue growth from the year 2016 to year 2020. Now, if I write the years 2016 to year 2020, you can simply see that I have written these here. But there's a problem in the year 2020 because there was a global pandemic known as COVID-19, and due to that pandemic, all the companies around the globe have suffered. All the companies' performance and the sale was drastically reduced. So this was an abnormal year for all the companies. And if we model our financial model based upon some abnormal years, then it can provide a bad result and bad modeling. So what we should do, we should not consider the year of 2020 in our financial model. However, there are different ways to identify the growth rates of sales. Many analysts talk to the management of the company, and based upon their discussion, the growth rate can also be identified. But for our modeling purpose, we are giving more weightage to the previous year data. So let me show you the sales revenue of the company for previous 5 years. So if I use the formula, if you say transpose, and then I go to income statement, inside the income statement, you can see the sale of revenue here, and I just wrote the formula. Along with that, if I go and write this formula of transpose and getting the sale revenue from financial products, we will find that these are the sale revenue from financial products. Now, you can simply see that from year 2016 to year 2017, there was a growth of total sale revenue. As you can see, it was 38,537, and then in 2017, it grew to 45,462. And then after it again grew, and there was a growth rate, but there was a little bit less growth rate, or I can say a negative growth rate of sales in the year 2019. But after the year 2019, the 2020 was a bad year, and this impact has been on all the companies around the globe. So this year should be removed from our analysis, because if we include this year in our analysis, it will not provide a good financial model. So I am removing the details from here, and now it's saying that you can't change part of an array because I have used the transpose formula, so I can't change the part of the array. So I am just copy and doing a paste special to these numbers. Now these are only numbers, not the formulas. And now I am deleting this the year 2020. Now once I have deleted the numbers, then what we can do, we can simply go and find our CAGR, that is our capital asset growth rate or compound annual growth rate in the case of this particular analysis. Now if you see that we have used D6, which is the last year's total sale revenue, divided by D3, which is the beginning year total sale revenue, and we have done it to the power 1 by 3. The reason we have used to the power 1 by 3 because this money has grown to 3 years, that is from 2016 to 2017, and then 18, and then 19. So we have used the power 1 by 3, and then I done -1 for our valuation. Now we got our CAGR, which means that our sales is growing annually on a rate of 11.76%. Now, we shall use this growth rate also for the year 2021 for our valuation of company. This rate shall provide a better representative, and we have not used the data of year 2020 because that data will definitely not help us for a better financial model. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out our operating current assets to sales ratio and operating current liabilities to sales ratio. For that purpose, I have prepared our Excel sheet, as you can see. Inside this Excel sheet, I need to write operating current assets divided by sales. So I shall write sum, and I shall go to my balance sheet, and inside my balance sheet, if I add all the items except cash and short-term investments, they are known as my operating current assets. So if we add all of them, you will get your operating current assets. And instead of adding them, we have already done our balance sheet rewriting, as you all know. So what I will do, I shall go to our balance sheet which has been rewritten and choose our operating current assets from there. Once I have chosen our operating current assets, I shall divide it with our, as you can see, the sales revenue. And when I divide it with our sales revenue, we will get our percentage of operating current assets to sales. The same pattern shall be applied to all the 5 years, and once we apply it on all the 5 years, we shall get our operating current assets to sales ratio. In the similar manner, we shall go and find our operating current liabilities to sales ratio. For that purpose, we shall go to our balance sheet which has been rewritten, and inside that we will find our operating current liabilities. And once we divide our operating current liabilities with our sales from income statement, we shall get our percentage of operating current liabilities to sales. The same thing shall be applied over all the years, and once we apply it on all the years, we shall get our every year's operating current liabilities to sales ratio. As we see the numbers of operating current assets to sales ratio, we can simply interpret that there is a consistency of this particular ratio. And also, if we see the operating current liability to sales ratio, there is also consistency in this. So based upon that, we can simply find the average of our operating current assets to sales ratio, and average of our operating current liabilities to sales ratio for modeling our financial model. These will be used in our projected cash flow statement and projected balance sheet for getting the future period numbers from 2021 year onwards. And based upon that, I see you in the next session. Till then, bye bye. I welcome you all. Let's discuss about net operating cost to sales ratio. Basically, net operating cost means your all operating expenses, and if you reduce the depreciation from that, we will get our net operating cost. So let's try to find out firstly our operating cost from profit and loss account. If we go to our income statement, as here as you can see, inside our income statement, these are our operating costs. These all are our operating costs. So I shall select our total operating cost of 38,039 from here. After that, we need to write our depreciation, and the depreciation can be found inside the cash flow statement. So I go to cash flow statement, and inside the cash flow, we can see the depreciation. Once we reduce the depreciation from our operating cost, we will get our net operating cost or operating cost net of depreciation. And after that, we already know what is our sales. For getting our sales, we can again go to our income statement, and in the income statement, our total sales is 38,537, and if I press enter, we will get our sales. After that, we can simply find our net operating cost divided by our sales. We will get our net operating cost to sales ratio percentage. And the same pattern we shall apply to all the 5 years, and let's see what we get. After applying this pattern, we can see that our net operating cost to sales ratio is consistent over the period, which means that this is near 90.8%, 84%, 79.8%, and near about this particular range. So simply we can take the average of our net operating cost to sales ratio for all the 5 periods. So we can see that it's 83.5% right now. We shall use these ratios and calculations while finally we shall prepare our final financial model. But before that, I will take your leave and I see you in the next session. Till then, bye bye. I welcome you all. Let's try to model our fixed assets to sales ratio. For modeling of our fixed assets to sales ratio, firstly, we shall go to our Excel. In our Excel, I have provided the details of our land, building, machinery, software, equipments, and construction in progress. Now, for getting these numbers, we have to go to our annual report. So this is our annual report as we know. This annual report is ending as on 31st December 2020. So I am providing the details for the year 2020. As we can see, the value of land for the year 2020 is $681. So I can just simply go and write the value of land as $681. Similarly, the value of building and improvements is $7,091. Now, you know that these numbers are in million, so I'm not mentioning that. So the value of building and improvements is $7,091. After that, we can go to our machinery and other equipments, and our machinery and other equipments is 13,004. And then we know that we are having software, equipments, and construction in progress. So I'm also taking these details and I'm just providing these details here. Once we provide our details here, all these assets are at their cost value. So I am just doing a total of all of them, and you shall get the total cost of all of these assets. After that, we shall go and find our accumulated depreciation. Now, you can see your accumulated depreciation inside the annual report, which is 16,870, and I just paste it here. Once we get the accumulated depreciation, we can get our net property, plant, and equipment, as you can see here, which is 12,401. After that, I have mentioned our sales details here. So what we will do, we shall go to our details of sales, and the sales details are inside the income statement for the year 2020. and these are the total sales is 41,748. Using these sales details, we shall calculate our gross property, plant and equipment to sales ratio. So we shall simply do our property, plant, equipment, which is the gross value, divided by our sales value, and we shall get our property, plant, equipment to sales ratio, which is 70.11%. After that, we need to provide our depreciation amount, and we shall go to our cash flow statement for finding our depreciation. And for the year 2020, the depreciation is 2,432. I have also written the depreciation rate on gross assets. So one thing which we need to understand at this moment, that there are two categories or two kinds of assets. One category of assets are depreciable assets and another is non-depreciable assets. Now, if you see that the land is a non-depreciable assets and construction in progress is also a non-depreciable assets, except that all the remaining assets are our depreciable assets, which means that this depreciation amount has been calculated on all the depreciable assets. So how we will calculate our depreciation rate is simply we shall take our depreciation and we shall divide it with our all the depreciable assets. So for that I shall use the formula of sum and use all the depreciable assets for the reference rate. Now you can simply see that the depreciation rate on our gross assets which are depreciable, I should write it, so I am writing which are depreciable, have been written here. Now after that, in the similar manner, what we shall do, we shall use all the 5 years for which we are doing the analysis. So I am unhiding the details, and if I unhide the details, we shall simply get the details of remaining 5 years because I have already calculated these numbers for your reference. Now once we have calculated these numbers, we know that we need to model our rates. So our average depreciation rate I have calculated as average of previous 5 period depreciation rates from 2016 to 2020, as you can see. Similarly, for modeling our gross property, plant and equipment, we can provide a reasonable estimate that our gross property, plant and equipment is 66.22% of our sales value, which you can simply say, or you can simply say that we can take the average of these 5 years gross PPE by sales ratio, so which comes to 66.22%. We shall use these details for modeling, or I can say for providing our financial model. Except that I see you in the next session. Till then, bye bye. I welcome you all. Let's discuss about the modeling of total dividend and dividend per share for all the previous 5 periods for Caterpillar Incorporation. For getting these details, let's come to our Excel sheet. On this Excel, I have written the dividends amount for year 2016 to 2020, and let's find the amount of dividend. As you know, the dividend can be found inside the cash flow statement. So inside the cash flow statement, you can see the amount of dividend is written. So I just paste the numbers here, and the number is being shown as negative because cash flow statement shows that as a negative number. But I need to show the amount of dividend, and for that purpose I am just converting this negative number into a positive number. And similarly, I can find the dividend of all the 5 years, as you can see. And we can see that the year-on-year growth rate of dividend has been here. Now what we can do, we only need to find what is our CAGR for dividend, because we actually want to know the annual compounded growth rate for our dividend. We had also seen similar kind of CAGR for dividend while we were calculating Gordon's growth model. So we know that the dividend has grown 4 times from 2016 to 2020. So inside the formula, we have simply used the dividend for the year 2020 divided by dividend for the year 2016, and we have done its power 1 by 4 because it had grown 4 times. And based upon that, we got our dividend CAGR, that is annual growth rate of 5.67%. However, this dividend is based upon the total amount of dividend. we can also find the dividend per share and its CAGR. So if I try to find dividend per share, we can go to our income statement. Inside income statement, we can simply get our cash dividend declared per common share. And if I paste the number here and I copy the number for all the 5 years, we will simply get our dividend per share for all the 5 years. And based upon that, we can also calculate its CAGR. So its CAGR will also be calculated in the similar manner, where you shall take the dividend of last year divided by the dividend of 2016 and whole to the power 1 by 4, because it had grown 4 times, and then minus 1 for getting the percent. So the CAGR of dividend per share is 7.54%. We shall definitely use this CAGR in our financial model in the forthcoming session. Till then, I see you. Bye bye. I welcome you all. Let's try to model our tax rate for our financial modeling purpose. For that, I go to our Excel sheet, and inside that Excel sheet, let's try to put our profit before taxes. And as you know, profit before taxes can be found inside our income statement. And inside our income statement, we can go and find our profit before tax like this. And this is our profit before tax. And I copy the same details for all the 5 years, and we get the profit before tax for all the 5 years. After that, I can simply put the taxes, and the tax amount again can be found from our income statement, and inside the income statement, this is the tax amount. Now, after that, if I just find our tax rate, then you can see that the tax rate in 2016 is too much higher. This is the one thing which you need to understand and note, that the income or the profits as per balance sheet may not be used for the taxation purpose, because under the income tax laws there are different deductions and different additions while finally computing the taxable income. So this 2016 year may have been an abnormal year, and after that, if we see that there was a tax rate of 81.80%, which may also have some of the important other events due to which we cannot use these two tax rates. But after that, if you see the year 2018, 19 and 20, you can see a consistency of tax rates here. Now, in the case of tax rates, majority of the analysts assume the latest tax rate. So here, instead of taking the, I welcome you all. In this module, we shall assemble and compile all the financial ratios which we have computed. All the financial ratio of sales, current assets, current liabilities, fixed assets, and all the other ratios shall be compiled. And after that, we shall try to understand and evaluate our financial model for projecting all the 5 years data from the year 2021 onwards. These ratios shall be used for projecting our income statement, our balance sheet, our cash flow statement, and our free cash flow for the firm, which we shall see into the later session. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to create our Proforma financial model, which means that we have prepared all the ratios, and now it's time to put them into a single sheet so that we can proceed for our analysis. For that purpose, you can see our Excel sheet here. Inside that sheet, we have prepared all the sales ratio details here. And now let's try to understand one by one all the ratios. So if you see the sales growth ratio, I can simply get it from here, which is 11.76%. And you know that we have already calculated this number from our sales analysis sheet, which is 11.76% herewith. After that, I show you that we have calculated our current assets to sales ratio, which is 62.33%. And we have calculated this number in our current assets or current liability analysis sheet. After that, we can simply see our current liability to sales ratio, which is 32.04%, which you can see simply from our, again, current assets to current liability analysis section. And after that, we can simply see our gross fixed assets to sales ratio. The gross fixed assets to sales ratio is 66.22%, which we have taken from our fixed assets to sales analysis ratio from this particular sheet. After that, we have calculated our cost of goods sold to sales ratio. This 83.54% we have already calculated from here. As you can see, this is 83.54% from our operating cost to sales analysis sheet. After that, we have calculated our long-term receivables. So you can simply see that it's 11.76%, and this 11.76% shall similarly grow just like sales, because these are the debtors and the debtors shall be growing based upon the sales. So we have assumed these two numbers to be same. After that, we have calculated our depreciation rate. The depreciation rate, which is 9.43% from our fixed assets to sales ratio analysis tab. After that, we have shown our pension liability, or we can simply say our liability for retirement. So you can see that these liability details for pension are given here, which is, I can just highlight this number, which you can see it's 7.43%, and this number we have taken from, you can simply say, our model value from our other liabilities and pension section. So after that, our other liabilities we have taken, and other liabilities have grown by 8.16%. So this 8.16% have been taken from other liabilities and pension section. After this particular detail, we have taken our cash to sales ratio, and this cash to sales ratio is 17.79%, and this has been calculated in our various other ratio sheet, as you can see here. And after that, if we go, our debt to asset value has been calculated, which is 47.31%, and we have calculated this number inside our various other ratio sheet, which is debt to asset ratio. And after that particular number, we have found our interest rate on debt. Now, the interest rate on debt, as you can see here, this interest rate of 1.50% we have calculated in our weighted average cost of capital model details. So if you go to our WACC model details inside our cost of debt calculation, you shall simply see that the interest rate on debt is 1.50%, which we have calculated there. After that, I have not considered any interest on cash and marketable securities, so I just have taken it as 0%. This is the dependent upon the author's guess and whatever you may assume. But for my assumption, I have taken that I don't receive any interest on the cash and marketable securities for the moment. And after that, we have calculated our tax rate, which is 25.18%. And if you go, you will simply say our tax rate we have calculated is 25.18% from our tax rate analysis sheet. And once more, finally, we have found our dividend growth rate, and this dividend growth rate is 5.67%, and this growth rate has been taken from the year 2016 to 2021, as you can see from our dividend analysis section. So in this way, we have prepared this whole Caterpillar's Proforma financial model. And from this particular Proforma model, we shall now project our balance sheet, we shall now project our income statement and then our cash flow statement, and based upon that, we shall value our shares. Before that, I just would take your leave and I see you in the next sessions. Till then, bye bye. I welcome you all. In this module, we shall learn about projection of all the items of income statement. These items will include sales, cost of goods sold, financing charges, our profit before tax, dividends, and all other things. Along with that, we shall also do a projection of all items of the balance sheet, which shall include the current assets, current liabilities, our shareholders fund, long-term liabilities, and all the other items inside the balance sheet. These projections shall be done for all the 5 years starting from the year 2021, 22, 23, 24, and 25. I see you in the next session. Till then, bye bye. I welcome you all. One important note to remember that we have not calculated all the items in the income statement at once and all the items in balance sheet at once. This thing has been done because there are certain financial items just like depreciation, which would be projected based upon the projected fixed assets. So for getting the depreciation, we need the fixed assets projection. So that what will happen that we have calculated certain items of income statement just like sales and cost of goods sold, then we went to the balance sheet and calculated certain items just like fixed cost, our cash and marketable securities, and then we came back to our income statement and then we projected our depreciation and so on. It means that all the items of income statement and balance sheet have been projected combinedly. You will see and understand what I mean in the forthcoming sessions. Till then, bye bye. I welcome you all. Let's try to project our sales in income statement. For that, we shall go to our Excel sheet. Inside our Excel sheet, as you can see that the base year is 2020 and for which we already know the sales details. So what I shall do, I shall go to our sales details for the year 2020 from the income statement. As you can see, this is our income statement and the sales detail for 2020 has been taken here. Now, after these details, we already know that our sales is growing at a speed of 11.76% as you can see here. So taking this data into our mind, we shall simply grow this sales on an annual basis. So I am just writing this number and the growth will be 1 plus, I can simply write the selection of this 11.76%. So it means that the sales shall grow on 11.76% on annual basis. And I am just freezing this cell. So we shall get the sales details for our 2021. In the similar manner, I shall copy these details till the year end 2025 and we shall get our projected sales details till the year 2025 from the year 2021. These all 5 years are our projected years and this is our the year for which we are already having the details. I see you in the next session where we shall project the cost of goods sold. Till then, bye bye. I welcome you all. Let's try to find our cost of goods sold projected numbers in income statement. For that purpose, we shall go to our income statement. And as we know that for the year 2020, we have already the details of cost of goods sold in our income statement. But we will show our cost of goods sold except depreciation here because we want to show our depreciation separately in our income statement. So I shall go to our income statement and inside our income statement, we know that for the year 2020, the total operating cost is 37,195. Now, from this operating cost, I shall reduce the depreciation because we don't want to show the number of depreciation here. So this depreciation number for the year 2020 has been reduced from here. After that, the number which we received is 34,763 is our cost of goods sold except depreciation. Now, this number is an expense, so I want to show this number in a negative sign. So what I shall do, I shall show the depreciation in a positive sign and the income of cost of goods sold except depreciation in a negative sign. So we will get our 34,763 as a negative number again. So earlier it was being shown as a positive number. Now I have converted this number into a negative number. Now, after that, we can see simply that our cost of goods sold is 83.54% of our total sales. So if we go to our statement, we can simply use our formula that our sales is 46,659 for the year 2021 and our cost of goods sold is 83.54% for the sales, and I freeze this cell and we get our cost of goods sold of 38,977. In the similar manner, we shall get our cost of goods sold for all the periods which you can see till the year 2025. I see you in the next session where we shall project our interest payment on debt. Till then, bye bye. I welcome you all. Let's try to find our cash and marketable securities projections in balance sheet. When we go to our financial model, we can simply see our cash and marketable securities inside this particular format. So, for the year 2020, we already have our cash and marketable securities. So, I go to our rewritten balance sheet. Inside rewritten balance sheet, if you see the year 2020, inside that the cash and short-term investment is written as 9,352, which I have written here. Now, after that, for the year 2021 onwards, we need to project the numbers. Now, as we know that we are having our cash to sales ratio of 17.79%, which means that our cash will be 17.79% of our sales. So I shall simply choose our sales, which is in our income statement, which is our projected income statement, and I shall multiply this number with our 17 point, where is it? I can see it's 17.79%. So I multiply this number and I freeze this number of 17.79%. Through that, we got our cash and marketable securities for the year 2021. After that, we can simply copy this formula and paste the same formula for all the months and years. Now, we can simply see our cash and marketable securities for all the years, which is projected based upon our cash to sales ratio. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to project our current assets in our balance sheet. For that purpose, we shall go to our balance sheet, and inside that, I am showing the operating current assets. Now, you know that our total current assets include our cash and the other operating current assets. We have already shown our cash and marketable securities in our previous session. Now we shall show our other operating current assets. For that purpose, for the year 2020, we can simply go to our rewritten balance sheet, as you can see here. Inside this rewritten balance sheet, under the current assets section, we can simply see operating current assets, which is 30,112, and we shall put this number here. After writing this particular number, we can go to our financial model ratios above, and we can see that our current assets to sales ratio is already given, which means that whatever sales we have projected, we can simply write our current assets based upon that. So I can simply go to our sales. As you can see here, we are having our sales of 46,659 in the year 2021, and I shall multiply this number with our projection model, which is our current assets to sales ratio of 62.33%, and I shall freeze this particular number because I need to use this again and again. And after that, we can simply see that our operating current assets for the year 2021 is 29,084. We shall simply copy this formula and paste in all the other cells, and we shall get our details of our projected operating current assets for all the years till 2025. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to project our fixed assets inside our balance sheet. For that purpose, we shall go to our Excel sheet, and inside our Excel sheet, you can simply see that fixed assets have been shown into three different categories. One is land, other is construction in progress, and other is other depreciable assets. So we have bifurcated our all fixed assets into these three categories. Now, if we go and try to find out the details for the year 2020, we are already having these details in our fixed assets to sales analysis sheet. In that sheet, in the year 2020, you can simply see the value of land is 681, which I am writing here. After that, we can simply write our construction in progress alongside from that fixed assets to sales analysis sheet. So this construction in progress for the year 2020 is 739. And after that, we can write our other depreciable assets. So I'm just having the formula of sum, And inside that formula of sum, I am writing fixed assets to sales analysis, and you can simply write and choose all these other depreciable assets of building, machinery, software, and equipment. And if I press enter, we will get our other depreciable assets at cost. After that, we can simply go and find our accumulated depreciation, and our accumulated depreciation for the year 2020 was 16,870, as you can see. And if we press enter, we will get a formula of sum, and in the formula of sum we will get finally our net property, plant and equipment of 12,401, which you can also see and verify from here, 12,401. After that, if we go to our financial model, we are putting one assumption that land and construction in progress will remain same for all the coming 5 years, because we are having no details about these two items, and these are in the category of non-depreciable items for a time being. So we are assuming these details. And after that, if we go to our financial model regarding other depreciable assets at cost, then we can simply see that we are having one ratio of depreciation rate, which you can see here. And there is another important ratio which we have already found out about, the gross fixed assets to sales. This ratio of gross fixed assets to sales is revealing one thing, that our gross fixed assets are 66.22% of sales. So inside this model, if we go to our gross fixed assets and I show you the gross fixed assets here. So our gross fixed assets is 66 point something percent of sales. So I'm writing the sales multiplied by this 66 point, where is this number? This number 66.22%, and I am just freezing this number because this is our gross assets. Now this is our gross assets at their cost except land and construction in progress, as we know, and the same pattern shall continue for all the 5 years. So I am just writing these numbers, and once you do that, we will get our other depreciable assets at cost for all the 5 years which we have projected. After this particular treatment, we really need our accumulated depreciation. Now you all should know that accumulated depreciation is the depreciation incurred till now from the date of purchase of the assets. So it includes all the depreciation. So we have not till now calculated the details about accumulated depreciation, but for that we need the depreciation of current year also. So we shall go to our income statement, as you can see, and inside our income statement we shall definitely model our depreciation here also. For modeling our depreciation, we already know that our depreciation rate is 9.43%. Now if we go to this 9.43% to our fixed assets to sales analysis, which you already know, this rate of 9.43% was calculated on gross assets value. So we shall also apply the same formula for calculating the depreciation rate here. And if we go to income statement, inside the depreciation section, we shall simply go to our gross assets. You can simply see the gross assets is 30,897. And if we multiply this gross assets with, I must write simply 9.43% of depreciation rate, we will simply get our depreciation amount for the year 2021. Let me change the color of these columns, and you will see that this is the depreciation amount here. Now how we have calculated these number, and this is an expense, so I need to show you this in a negative way. Now in the similar pattern, if I copy this formula and paste till the end of year 2025, and we will get our final depreciation amount for all the 5 years till year 2025 as this number. Once we have calculated our depreciation, we already know that our accumulated depreciation means depreciation incurred till today over all the assets. So you shall say this was my previous depreciation. Along with that, I am having this new depreciation of 2915, and when you add both of these depreciation, you will simply get your accumulated depreciation here. And after that, you can simply copy this particular formula, and we can simply paste these numbers in all the cells, and you can simply see all the accumulated depreciation till the year 2025. After that, we can simply copy this formula of net property, plant and equipment also, and if we copy and paste these numbers, we shall get our net property, plant and equipment till the end of year 2025, which is 14,330. This 14,330 is representing that for the year 2025, we are having our land of 681, construction in progress of 739, other depreciable assets at cost of 48,209. From that, we have reduced our accumulated depreciation and we get our net property, plant and equipment, which you can see right now. In this way, we have modeled our fixed assets inside our balance sheet and the corresponding depreciation in our Excel sheet right now in our income statement. Also, we can simply write the depreciation for the year 2020, which you already know is the depreciation for the year 2020 inside the cash flow. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to value our long-term receivables projection in balance sheet. For that purpose, we shall go to our balance sheet, and inside our balance sheet, we can see long-term receivables for the year 2020. For the year 2020, we can simply go to our balance sheet or our rewritten balance sheet. So if we go to our rewritten balance sheet, we can simply see our long-term receivables for the year 2020 are 13,407, as you can see. Also, from our financial model, which is here, we already know that the long-term receivables will have a growth rate of 11.76%. So we shall simply go to our balance sheet. Inside our balance sheet, we can simply choose our trade receivables, and these long-term receivables, we shall simply grow these long-term receivables at the rate 11.76%, and if we press enter, we will get our number of 14,984 for the year 2021. If we copy these details and paste till the year 2025, we shall get our all final numbers, which you can see these have been updated now. For the year 2025, it's 23,380 as long-term receivables inside our balance sheet. So in this way, we have projected our long-term receivables, and after that, I see you in the next session. Till then, bye bye. I welcome you all. Let's discuss about modeling of our deferred income tax and intangible assets. For modeling of these items, I go to our balance sheet, and inside this balance sheet, we are having the details for the year 2020, and we just put the details of non-current and deferred refundable income tax from our rewritten balance sheet. So we go to our rewritten balance sheet, and you can simply see 2020, and inside that our non-current deferred and refundable income tax is being shown here. So we select that, and this number is here. After that, we select our intangibles and some other assets, and we take a formula of sum, and again we go to our rewritten balance sheet, and inside that we can simply see that our intangibles for the year 2020 along with some other assets are here, and we press enter. Now these items can be evaluated further and can be introspected further, but for these items, the company need to discuss with the management, and once the management provides sufficient details about future intangibles or deferred refundable income tax, these numbers can be changed. But as for our assumption, we are assuming that these numbers shall remain same throughout all the 5 years in the absence of any information from the management. So we are just taking these numbers, and these numbers shall be same throughout the year. Once we have done that, you can see that our balance sheet total can be done here right now. So if we go and try to do our total, so we can simply select our cash and marketable securities. Along with that, we can choose our operating current assets. After that, we can select our property, plant and equipment and our long-term receivables. And after that, our non-current deferred and refundable income tax. And lastly, our tangible, intangible and other assets. So if we get this particular number of 78,324, and if we apply the same formula here, then I am just selecting the, because I have colored it into the white. So if we apply the same formula over all the years, we will get our total assets for all the forthcoming 5 years. In the similar manner, we shall go through item by item in the liability also, and I see you in the next session. Till then, bye bye. I welcome you all. Let's try to project our current liability in balance sheet. For this purpose, we shall go to our balance sheet inside the current liability section. And in this current liability, we can write the current liability for the year 2020. Now, for the year 2020, the current liability can be taken from balance sheet, which is rewritten. In the balance sheet in the year 2020, we can simply see our operating current liabilities of 14,553, and we can just select this number here and just write it here. After that, in our model, we can simply see that there is a relationship of current liabilities with sales. It means that your current liabilities are 32% or 32.04% to be precise of your sales. So we go to our model again, and in our model we just write our current, our sales, where it is. You can simply say we just go to our profit and loss account, or I must say income statement, and we can just multiply this sales number with our specified number of current liability, which is 32.04%, and we just freeze this particular number because this number is going to be used in all the cells. And if we copy paste this detail, we will simply get our current liability for all the 5 years starting from 2021 to 2025 for our company Caterpillar Incorporation. After that, we shall model our liability for post-retirement benefits. For that, I see you in the next session. Till then, bye-bye. I welcome you all. Let's try to model our liability for post-retirement benefits projection. For this particular purpose, we shall simply go towards our balance sheet, and inside our balance sheet, we will select liability for post-retirement benefits. Now, for that purpose, I am just selecting these numbers, and for that purpose, we shall simply go into our balance sheet, and inside our balance sheet, we can select our post-retirement benefits from here, as you can see. These numbers are here, as you can see, is 6,872. Or we can also take this number from our balance sheet, which is rewritten, and from that rewritten balance sheet, we can take number for the year 2020. And if I press just enter, we will get this number. Let me again highlight this into the black, and we get this number. After that, we can see that we have modeled our post-retirement benefits with respect in our Proforma Caterpillar model. So if you go and see our pension liability growth or the post-retirement liability growth, it is a negative growth, which means that these numbers shall be constantly reducing year on year basis. So we are just going here and we are just selecting our previous period liability, and along with that we are selecting our simple pension growth rate or the post-retirement growth rate, that's the same meaning, and I'm providing this into a fixed or fixed cells. And once we select that, there is an error, and I think that I need to write minus sign here, and still there is an error. So let me see what is the error. Okay, so I don't need to write the minus sign here, I just need to put multiply sign here, and once I put it, you can see that your liability for post-retirement is reducing. And if we keep on copy pasting these details, we shall keep on receiving our reduced liability year on year for the post-retirement benefits. We have modeled this thing for our financial modeling and valuation purpose. After this thing, we shall see our other liabilities and remaining things in the forthcoming sessions. Till then, bye bye. I welcome you all. Let's try to project our other liabilities in the balance sheet. For that purpose, I'm going to our other liabilities in the balance sheet for the year 2020, and for the year 2020, I'm just going to select the other liabilities from our balance sheet, which is re-return, and the amount for that other liability is simply 4,358, and I select that number and we get our other liabilities here. After that, if we try to find our other liability for the year 2021 to year 2025, we can simply try to model it. And if we go to our modeling sheet, we can simply see that our other liabilities will be growing at a rate of 8.16%, which means that we are having our other liability of 4,358, and we shall grow this liability with a certain rate. The rate which is here, which we already selected, is 8.16%, and based upon that rate we shall get our projected value of other liabilities for the year 2021. And after that, we shall copy these details and paste into the sheet, and we shall get our projected liabilities for all the 5 years from the year 2021 to year 2025. And based upon that, I see you in the next sessions. Till then, bye bye. I welcome you all. Let's try to project our debt in balance sheet. For projecting the debt, I am going to our balance sheet, and inside that, first thing which you need to understand and note, that there is no bifurcation or differentiation between the short-term debt and the long-term debt in our balance sheet for modeling purpose. So I am choosing both kind of debt inside our balance sheet for the year 2020. So if we go to year 2020, we can simply go to our balance sheet re-return, and inside that we have selected and prepared our financial debt, as you can see, which is 37,163, and we select that number. And wait for a second, I have not used the equal sign here. So if I use the equal sign here and we go to our balance sheet, which is re-return, and we select our financial debt for the year 2020, we can simply write it as 37,163. Once we have returned this financial debt, then we can go towards our modeling, as you can see, and we already know that our debt is 47.31% of our total asset, as you can see here. So we shall simply go to our financial model, and we shall select our total assets from above, and we shall multiply this total assets with our financial modeled debt, which is 47.31%, and we shall just simply press enter. And once we press enter, we get the details of our projected debt for the year 2021. Now based upon that details, if we copy and paste, we will simply get the results of our debt for all the 5 years till 2025. With this, our modeling and projection of debt has been completed. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to project our common stock in balance sheet. For that purpose, we shall go to our balance sheet, and inside that we shall select the year 2020. In the year 2020, we can go to our simple balance sheet, as you can see, which is re-return. Inside that, we already know that our common stock is of 6,230, and we select that number. Now, generally, it all depends upon the management discussion whether they are going to issue new shares in the forthcoming years. But in the absence of any information, we are assuming that the common share amount will remain same for all the years which are going to come. It all depends that how much discussion and how much detailed discussion you have with the management for the common stock and about their issue dates. But for our understanding and our modeling purpose, we are just making the common stock similar in all the 5 years. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to project our cost of goods sold in income statement. For that purpose, we shall go to our income statement. And inside income statement, you can simply see that for the year 2020, the cost of goods sold except depreciation is written here. Because we have shown our depreciation separately in our income statement earlier. Now, we shall go to our income statement for the year 2020. And inside the income statement for the year 2020, we can simply see our total operating cost. Now, inside this total operating cost, it's already depreciation is hidden inside it. So we have to remove the impact of this depreciation. And also, we need to show these expenses as negative. So I'm writing negative 37,195. After that, we need to remove the impact of the depreciation. So inside the cash flow, when we simply go, we can see our depreciation is 2432. And based upon that, let me just convert this number to a different sign. And if I press enter, you will simply say that your cost of goods sold except depreciation is total 34,763. How we have calculated it? We have simply removed the impact of our depreciation inside our total operating cost. After that, we already know that inside our financial model, we are having our cost of goods sold to sales ratio as you can see here. So this is the cost of goods sold to sales ratio as 83.54%. We shall use these details for finding our cost of goods sold. So this is our sales and we shall multiply our sales with our cost of goods sold ratio here. And I shall freeze this because we shall need it later on also. And I shall press enter. Once we press enter, we will simply get this number. Now, we are showing the expenses as negative, so I am showing the minus sign here. After that, we shall copy paste this formula alongside all the cells and we shall get our cost of goods sold except depreciation for all the years till 2025. In this way, we have projected our cost of goods sold. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to project our interest on debt in our income statement. For that purpose, we shall go to our balance sheet and income statement. Inside our income statement, you can see that there is a column of interest payment on debt. For the year 2021, we shall try to project it. Now, for the year 2021, we have already calculated our total debt amount. So we shall go to our total debt amount. As you can see, this is a total debt of 36,881 for the year 2021 and so on for all the 5 years of our projection. This debt includes both the short-term and the long-term debt as we have computed it earlier. Also, we have calculated our interest rate on debt as 1.5% from our previous sessions as you remember. Now, if we apply this interest rate of 1.5% on the debt we have computed, we shall simply get our interest on debt. So I am just writing minus sign because we are showing these numbers as minus. So 1.5%, I am freezing this rate and then I am multiplying the same rate with our debt amount. So our debt amount is, as we can see, debt amount is 36,881. Once we enter this number, we will get our 552 interest payment on debt. And I shall copy this number to all the 5 years and we shall get our final interest payment on debt for all the 5 years projection. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out our interest on cash and marketable securities. In our financial model, we have assumed our interest rate as 0%, which means that we are not investing our cash and marketable securities at any place. For that reason, our interest earned on cash and marketable securities I am writing as 0. These numbers may be different based upon your assumption about the company's investment, but for our analysis and assumption purpose, I have taken this number as 0%, which means we are not earning any interest on our cash and marketable securities at the moment. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to compute our profit before tax in our income statement. For that purpose, we shall go to our income statement and there is return profit before tax. And inside this profit before tax, we have already calculated our numbers. We just simply need to convert these numbers and use them. So this is our profit before tax. If we sum all of these numbers, as you can see above, these all numbers are reflecting our profit before tax. These profit before tax shall be used further for calculating taxes on these. So I see you in the next session. Till then, bye bye. I welcome you all. Let's try to compute our taxes in our income statement. For this particular calculation, we shall see that our profit before tax is already given. And after that, we have calculated our tax rate in our Caterpillar Proforma model. Let me highlight this as black. So this tax rate has been calculated as 25.18% for our Caterpillar company. We shall apply this tax rate on our profit before tax. And I need to show this number as minus because I am just going to show the numbers in negative sign because this is an expense. So I am applying this number and I am multiplying 20 tax profit before tax with our tax rate and I am freezing the number. And once I do that, we shall simply get our number of profit before tax of 1062. Once we do that, we shall copy and paste this number to all the 5 years and we shall finally get our taxes amount for all the 5 years. After that, we shall go to our profit after tax and compute it. Till then, bye bye. I welcome you all. Let's try to compute our profit after taxes in our income statement. For that particular purpose, we shall go to our Excel. We have already calculated our profit before tax for all the 5 years and our taxes also for all the 5 years. If we add both of these numbers, then we shall get our profit after tax. What do I mean by adding here? The number is already in minus, so the net effect of both of these numbers will be our profit after tax, which is 3154. We shall copy this number and paste to all the 5 years so that we will get our final profit after tax for all the 5 years. After that, we shall calculate our dividends. For that, I see you in the next session. Till then, bye bye. We welcome you all. Let's try to project our dividend inside our income statement. For that purpose, we shall go to our financial model. And inside this income statement for the year 2020, we already know that we are having our dividend inside our cash flow. So we shall go to our cash flow. Inside our cash flow in the financing activities, we already know that we are having a dividend of 2243. And if we press enter, we will get the amount of dividend of 2243 here. After that, we already know that we are having our dividend growth rate return in our Caterpillar Proforma financial model, which is 5.67%. So we shall use this growth rate of dividend for modeling our dividend for all the forthcoming 5 years. So I shall use this number of dividend of 2020, multiply this number with the growth rate of dividend, which is 5.67%. I shall freeze this number and close the brackets. After that, you will get the dividend projected for the year 2021 of 2370, and I shall copy paste these numbers in our Excel and we shall get the dividend numbers for all the 5 years. As you can see, these have been updated now. After the dividends, we shall go to our retained earnings, which we shall see into our next session. Till then, bye bye. I welcome you all. Let's try to project our retained earnings in our income statement. For that purpose, if we go to our retained earnings section, you can simply see that we have earned the profit of 3154 for the year 2021. And we have paid a dividend of 2370 out of this earning of 3154. So our balance amount would be our retained earnings. So we use the formula. And our retained earning for the year 2021 is 784. Now, if we copy this retained earning and paste to all the cells, we will simply get our retained earning for all the 5 projected years in our income statement. In this way, we have completely completed our income statement projection. And there are certain items inside the balance sheet which are still pending to be projected. because these items are totally dependent upon the income statement items. So we shall go and project these numbers also in our forthcoming sessions. I see you till then. Bye bye. I welcome you all. Let's try to find out our profit employed in the business projection in the balance sheet. For that purpose, we shall go to our Excel sheet, and inside our Excel for the year 2020, you can simply see that our profit employed in the business can be taken from our balance sheet or simply re-return balance sheet. So inside re-return balance sheet, you can simply see our profit employed in the business for the year 2020, which is 35,167, and I have returned this number here. After that, as you know that this profit employed in the business keep on increasing by every year's profit also. So it means that we were having a profit of 35,167 in the year 2020. And after that, in the year 2021, as you can see that we are having a profit of, you can simply see that in the year 2021, we are having a profit of 784 in the form of retained earnings, which shall be added to the profit during the year inside the balance sheet, because originally we have earned a profit of 3,154, but out of that we have paid a dividend of 2,370, due to which only 784 remaining profit in the name of retained earnings shall be added to our profit of 2020. So our total profit for the year 2021 shall be the profit of 2020 plus the profit of 2021, which is the retained earnings. In the similar pattern, if we shall keep on using this formula for all the years till the year 2025, we all shall get simply our, let me see, yeah. So we all shall get our profits employed in the business for all the projected years 2021, 22, 23, 24, and 25 in this manner. In this way, we have calculated our profit employed in the business, and I see you in the next session. Till then, bye bye. I welcome you all. Let's try to project our treasury stock inside our balance sheet. For that purpose, we shall go to our balance sheet, and in the year 2020, you can simply see the treasury stock cell here. Inside this cell, we shall just go to our re-return balance sheet, as you know, and inside the re-return balance sheet, we know that our treasury stock at cost is being shown as negative 25,178. Now, for the year 2021 onwards, you already know that there are different methods through which the company can talk to management and they can get to know about the treasury stock futuristic data. But at this time, I have to put one assumption through which our balance sheet get matched. For matching our balance sheet, I can simply assume that the number of treasury stock will be your total assets. From the total assets, I shall simply reduce our, wait for a second, I shall simply reduce our sum of these liabilities and also the profit employed in the business. In this way, what will happen that we are getting a treasury stock in a negative number, that is 27,135. Now, if you try to show that your balance sheet is matching or not, for that purpose, you can simply write the equals to and sum, and then inside this sum, we shall do a sum of all the items inside your liabilities, and you can simply say your total equity, and I can write and liability side is matching with the assets, as 27,952 is matching with 77,952. Now, it's very simple that why I have done this. The basic goal of me is to match the balance sheet at the moment. But different companies may have different projections about their treasury stock. So in that case, we need to find a balancing figure in the stock also. But I'm not showing you answers through that assumption. It's very simple assumption for our treasury stock valuation. The different assumption can also be taken. So if I go further and if I just copy paste these numbers, you can simply see that your treasury stock for all the years can be found here. Can you see this? You will say yes. Once you see this, I shall also copy the formula of our total equity and liabilities here, and you can simply see that your equity and liabilities, your assets and liability for the year 2021 are matching. As you can see, it's 77,952. For the year 2022, it's matching again 84,490 with 84,490. For the year 2023, it's matching again. For the year 2024, it's matching again. And lastly, for the year 2025, you can simply see again it's matching. So in this way, we have prepared our projected balance sheet. As you can see, we have prepared our projected income statement, and we have prepared our Caterpillar's Proforma financial model till now. Now, after that, we shall go further and try to find out the free cash flow for the firm so that we can find the intrinsic value of the shares at the end. I see you in the next session. Till then, bye bye. I welcome you all. In this module, we shall learn about format for free cash flow for the firm. After that, we shall learn how to insert the profit after tax details. We shall learn the treatment of current assets inside the free cash flow statement. After that, we shall learn about the treatment of current liabilities in the free cash flow statement. After that, we shall find the treatment of capital expenditures of all the assets in our free cash flow for the firm statement. And after that, we shall understand the adjustment of interest, and lastly we shall find the projected free cash flow for the firm. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to project our free cash flow for the firm, and for projecting that free cash flow we need to use certain format. Let me show you the format, and after that we shall start one by one. Firstly, for all the 5 projected years, we need to write our profit after tax. After that, we need to add back our depreciation inside that format because depreciation is a non-cash item. Once we have done that, we can simply do the adjustment for our NWC, that is net working capital. Now, I tell you one thing, that if you have ever prepared the cash flow statement of any company, then you should know a set of rules. As a set of rules, if your current asset increases, your cash flow will decrease, and if your current asset decreases, your cash flow will increase. Similarly, if your current liabilities increases, your cash flow will increase, and if your current liability decreases, your cash flow shall decrease. If you are not aware about these particular rules, you can definitely go to our appendix section where you shall find in detail about why these things happen. Once you have done the adjustment of net working capital, we shall go and subtract our CAPEX, that is capital expenditure. Whenever you purchase any assets, then it creates an outflow of cash. So if there is an outflow of cash in the name of CAPEX, we shall reduce it here. As you know that we are calculating free cash flow for the firm, which means that these cash flow are for the firm, and inside the firm there are important 3 category of stakeholders. First one, your equity shareholders, which we call common shareholders also. Secondly, your preference shareholders, and thirdly, your debenture holder. In the case of Caterpillar Incorporation, we have only seen the common equity shareholders and the debenture holders, that is debt holders. So these free cash flow belong to both of debenture holders and your common equity holders. So definitely you shall add the earnings of interest by debenture holders, which is after tax, for all the 5 years here. Once we have done all these things, we will simply find our free cash flow. And for getting the details about how these items are being treated, that is how this depreciation is being treated, what is the working capital, what are your capex, I have already provided you one appendix details inside the attachments of the lectures. You can see that and understand that. But for modeling purpose, I am just trying to make you understand that how we can proceed. If you have already studied, and if you have already not studied, then simply you can go and refer that. From the sessions onward, we shall be discussing about each of items separately. I see you in the next sessions. Till then, bye bye. I welcome you all. Let's try to find out our profit after tax details for our free cash flow for the firm, which is very simple. We already know that we have received our profit after tax from our income statement, which is our projected income statement. And inside this, you simply see that your profit after tax is written here as 3,154 for the year 2021. And I shall enter this number here, and this number can be seen here. Once this number is entered, we can simply copy and paste these numbers here so that we get the details of profit after tax for all the 5 projected years from our income statement. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out our depreciation details for our free cash flow for the firm. For that particular details, we shall go to our projected free cash flow for the firm sheet, and inside that we shall try to find out our depreciation. Now you know that we have found our depreciation inside our projected income statement. As you can see here, this is our depreciation, and we really need to add this number, and this is already inside a negative sign. So we need to add this number. So I am just writing a negative sign here so that this negative number shall be converted into a positive number for our purpose. And you can simply see that our depreciation can be seen here. Once our depreciation is written here, I can copy and paste these details for all the 5 years, as you can see, and we have added our depreciation for all the 5 years. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to understand the treatment of our current assets for our valuation purpose. So, as you know that for the cash flow purpose, I have already told you that if there is an increase in current assets, it is reflected as a negative sign or cash outflow, and if there is a decrease in current assets, it is shown as a positive number or increase in cash flow. So, if we go above and I let you show that inside the balance sheet, you can simply see that for the year 2020, the operating current assets is a positive number, which is 30,112. Now, for the year 2021, as you can see that there is a reduction inside this current assets. So it means that it increases your cash flow. So if I try to show you the numbers, just try to see the numbers. So you will say that my cash flow has been increased, so it's 30,112 minus 29,084. So you will say for the year 2021 my operating cash flow has been increased due to current assets. Similarly, if you see the year 2021 and year 2022, you will say your current assets has been increased from the year 2021 to 2022, which means there is a cash outflow, because whenever your current assets increase, it creates a cash outflow. So you will similarly say it's 29,084 minus 32,506, and you will get an outflow of 3,421. Now, these numbers shall be used there inside our free cash flow statement. So inside our free cash flow statement, if we go there, we can simply write our increase in current assets. So you can simply go and you will say it's B34 minus C34, and you will say it's a positive number because it's increasing the current assets. And similarly, if we copy paste these numbers, you will see that all the details for current assets have been inserted. I tell you again, whenever the current assets increases, it creates an outflow, and whenever current assets decreases, it creates an inflow. So I see you in the next session. Till then, bye bye. I welcome you all. Let's try to understand the treatment of current liabilities in our projected free cash flow for the firm statement. So inside our this particular statement, I have told you that whenever current liability increases, our cash flow increases, and whenever our current liability decreases, our cash flow decreases. So if you go to our projected current liabilities, you can simply see for the year 2020 and 2021, you can simply see that for the year 2020, your current liabilities were 14,553, And for the year 2021, your current liabilities were 14,949. In this way, we can simply say that, as you can see, that our current liabilities have been increased. And what is the amount of that increase? You will simply say the difference of both of them, that is 396. The current amount or the current liabilities which had been increased, this shall increase the cash flows. Similarly, if you see the year 2021 cash flow of if you see for the year 2021 current liabilities and for the year 2022 current liabilities, you can again see that the current liabilities are increasing, which shall increase your cash inflows. So inside our free cash flow statement, what we shall simply do, we shall simply add the increase in current liability. So let me change the color of this particular statement, and inside that we can simply go to our current liability, and you can say for the year 2021 minus year 2020, you can simply see that your current liability were increased, so that your cash flow has been increased. Now if we copy and paste the same formula inside all of our years which we projected, we will simply get our numbers which shall be reflected as a cash inflow for the firm. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out the treatment of our capital expenditure, that is, we call it as CAPEX, in our free cash flow for the firm. For that purpose, we already know that if we have done any additional capital expenditure in the name of any assets, that creates an outflow for the firm. So if we go above and inside our projected balance sheet, you can simply see that we are having our assets at cost in the name of land, construction in progress, and other depreciable assets at cost. So if you see that for the year 2020, if you add all of these numbers, you will say that we are having a total of 29,271, which I can show you here. I can show you this number, that for the year 2020, you can say that your total cost of all the assets which you have purchased is 29,271. And for the year 2020, if you go, you see that your total cost of all the assets which you have purchased is 32,317, which means that you have done an additional capital expenditure or capex of 3046. Now this number is definitely creating a negative number, or this number is definitely an outflow for the firm, as you can see and you can understand. So in the similar manner, we shall calculate the outflow for each year in the name of capital expenditure. So if I go to our capex and I shall simply write, let me change the color of this particular statement first, and I shall write sum, and inside the sum I shall write what is my, if you can see, it's our expense or the cost for the year 2020. From that I shall reduce the sum of the cost in the year 2021, and if you see that, we will get our number that we have an outflow of 3046 in the year 2021 in the name of our capital expenditure. As you can see from here also 3046. Now let's come to this number also. In the similar manner, we shall calculate this capex for all the 5 years which we have projected, and if you see that these all are our capital expenditure for every year which we have projected, which means that for every year we have done an extra outflow in purchasing some capital assets or capital expenditure for our business. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to understand the treatment of our interest after taxes. For that purpose, we shall go to our Excel sheet, and inside that there is one row stating add back net interest after taxes. So we shall simply go to our interest amount, which is in our projected income statement. As you can see here, this is our projected income statement, and this is the interest amount. Now this interest amount needs to be made after taxes, so we can simply multiply this interest amount with 1 minus our tax rate, which is 25.18%, and I am freezing this 25.18%. And if I click enter, we can simply get our interest after taxes. But wait, we need to show this number as a positive number because we are showing that this needs to be added back. So I'm just writing a negative sign here so that we get a positive number of 413 here. After that, we shall copy and paste these details to all the columns for our financial modeling, and we shall get our total all the interest after taxes amount. After that, we shall definitely go and find our free cash flows, and that thing can be done in the forthcoming sessions. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to project our free cash flow for the firm in our Excel sheet. For that purpose, we just go to our Excel sheet and we shall just take all the numbers for 2021, 2022, 23, 24 and 25 years. So simply I shall write sum, and when I write sum, and after that I shall add these numbers, and we shall simply get the total number of free cash flow for the firm. Similarly, we shall copy paste these numbers to all the years, and we shall get our free cash flow for the firm for all the 5 projected years, as you can see from here. Once we have done that, we will go and try to value our firm and try to find out intrinsic value in our later sections. I see you then. Till then, bye bye. I welcome you all. In this session, we shall learn about our long-term growth rate for the firm, along with finding the intrinsic value of the share, and finally, our buy or sell recommendation for the share for our company, Caterpillar Incorporation. This shall be our important session where you shall understand that based upon what factors do we recommend our buying or selling of any particular share. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to analyze our long-term growth rate and the terminal value for our Caterpillar Incorporation company. For that purpose, we shall simply go to our Excel model. Inside that, we already know that we are having our WACC as you have calculated in your WACC sheet, which is 6.98%. So we take and select that number. After that, we need to write our long-term free cash flow for the firm growth rate. Now, this growth rate depends upon multiple factors, just like management discussion analysis, the information about the future, the economic scenario, the performance of the company, and a lot of important factors. For our modeling purpose, I am assuming this rate to be 5.5% for the time being. After that, we shall go and try to find out our free cash flow, which we have already calculated. As you can see, it's 4,859 for the year 2021. And for all the 5 years, we will write these cash flows here. Once we write here, we shall try to find out our terminal value. For finding the terminal value, we already know that we shall take the cash flow for the year 2025 and we multiply it with 1 plus the sustainable growth rate, and then we simply divide it with our WACC minus our long-term sustainable growth rate, and we get our terminal value here. Once we get the terminal value, we can simply do a addition of these cash flows, and once we do the addition, we will simply get these numbers as you can see here. Let me do a total of these numbers. So this is, yes, these numbers have been updated. These are our updated terminal value cash flows. As you can see, 1,94,153. This terminal value cash flows totally represent one important fact that the company shall be continuing till the foreseeable future. So it will have the cash inflows even after the year 2025 for the year 2026, 27, 28 and so on. So what is the value of all those cash flows which will be arising after the year 2025 are 1,94,153. So these are our terminal values and these are our free cash flows. Now, based upon these cash flows, we shall try to find out the present value and the intrinsic value of our share, which we shall see into the later sections. I see you in the next session. Till then, bye bye. I welcome you all. Let's try to find out the intrinsic value of our share. For finding the intrinsic value, we shall firstly find out the present value of all the free cash flows and our terminal value. For that purpose, I shall divide the cash flows of all the years with our 1 plus WACC to the power number of years. So this is the first year. So the present value of cash inflow from the year 2021 is 4,542 point, I can write 32. This is the present value of the year 2021. In the similar manner, if we try to find out the present value of cash inflow for the year 2021, 2022, we can again calculate it, and it's like it's the second year, so I'm just making to the power 2. Similarly, for the third year, we shall do cash inflow divided by, I can write 1 plus our WACC, and this is the third year of our prediction, so to the power 3. Similarly, we shall go to the fourth year because this is the fourth year of our prediction and projection. This number of cash flow divided by 1 plus WACC to the power, we can simply write 4. And lastly, the present value of our cash flows and the terminal value will be the total amount of cash flow and the terminal value divided by 1 plus. I'm writing the WACC to the power 5 because this is the fifth year. If we add all of these numbers, we shall get our enterprise's value or the total value of overall firm. We shall write this enterprise's value in our next sheet here for our calculations purpose. Now, this means that as on today, the overall value of the enterprises or the Caterpillar Incorporation is 1,50,396. Now, along with that, we know that except this value, the company is also holding some initial cash as on today, which means 2020, and that number can be simply taken from our balance sheet. So for the year 2020, we are having our cash of 9,352. Now, if we enter this number, we will say that the total value of the company is the enterprise's value plus initial cash available right now. So this is the total value of the asset. This means that if anybody would want to buy the company today without any liability, the valuation of the company is 1,59,748. But now, definitely the company is having certain categories of debt. We have to reduce those debt so that we will get the value of equity. Now, any kind of debt in the name of post-retirement benefits, our short-term debt, our long-term debt, or any other kind of liability except our operating liability will be paid off. So in this case, we shall just take our all these debts, and I'm just taking these debts, and for that purpose, wait for a second, this is the sum, and I go to in our balance sheet. Inside our balance sheet, we can simply see that these are our current liabilities. But except the current liabilities, there are three kinds of amount of debt which we need to pay to outsiders, because these all are our liabilities which needed to be paid. So we are just trying to find out the value of equity, which means that if we reduce all our liabilities for outsiders, then we will get the value of our equity. So I just write this number and we say that this is our all debt except current liability. Now, what is our equity value? We will simply take our total asset value, and from that asset value we shall reduce our total debt, then we shall get our equity value as on today. After getting this equity value as on today, we need to write our number of shares, and as you know, we are having a total number of shares as 547.47 million. This number has been calculated and found from Yahoo Finance, and while we were calculating our WACC, we already know this number, right? Or you can simply again see this number from our WACC sheet that our shares outstanding is 547.47 million right now. So what would be the intrinsic value per share? You will simply say that this 1,11,355 is the equity value for overall company, and if we divide this number by our number of shares outstanding, we shall get our intrinsic value of share, which is 203.40. At the same time, if we try to find out what is the current market price per share, then the current market price we already know from our WACC sheet, or you can simply go on Google and try to find the current market price, and the current market price is 193.13. So this is 193.13. It means that our intrinsic value, which we have calculated, that this is the intrinsic value or the fair value of the share which should prevail in the market. But while the current market price is 193.13, which means that this share is undervalued, because the actual value of this share should be 203.40, while this is valued at only 193.13, which means it is undervalued. And whenever anything is undervalued, they things or the shares will increase in price at a later date. And if this share is going to increase in price, definitely the recommendation for this share would be buy recommendation. So in this way, we have done our financial modeling and we finally found our intrinsic value per share. I see you in the next session. Till then, bye bye.